Most exclusive interview with Credit Suisse's CEO Thomas Gottstein and Chairman Antonio Horta Osorio. We didn't get to hear from Antonio in that particular clip, but nevertheless, what he is effectively is a new broom coming in, new plan. They're moving away from the prime brokerage business, which caused so much trouble to the business as a result of the Archegos blow-up, moving towards a fairly big pivot towards wealth management. That move certainly accelerating. The big question, though, really, for Credit Suisse, Alex, is can they draw a line under the past scandals that the bank has seen? Joining us now, Michael Moore, Bloomberg Finance Managing Editor for EMEA. Michael, that's the question. So Antonio Horta Osorio coming into this business, he now has a new plan. Is it enough? Are the scandals done? Is this going to be a lower risk business going forward?
Well, it certainly looks that way. I mean, moving capital from the prime brokerage to wealth management certainly lowers the risk profile of the bank. I think some investors were expecting something a little more radical or more cost cuts, which we didn't see much of. It was more about how can we grow this business rather than continuing to cut away on the cost base.
So that's Credit Suisse. That's on one side. On the other side, we have SocGen. Bloomberg also spoke to CEO of SocGen earlier on their numbers.
We have overall a very strong performance on the capital markets, plus 8% compared with last year, driven by a very strong performance of the equity business.
So the equities rebound really extended, provisions declined. How long can they sustain it? How does it compare to the U.S. guys?
Yeah, we saw equities up pretty much across the board at a number of banks, but SocGen did stand out with a bigger jump, and they had struggled a year ago. So it seems like they're getting back on track in that business, and that kind of lifted the overall results along with lower loan loss provisions.
Are they going to be able to sustain this? Like, they've almost doubled profit in the space of a year. Equity is super strong, beating Wall Street. There's a number of divisions here that are really firing on all cylinders. Is this something that SocGen can keep going with?
Well, I think that's not just a SocGen question. That's kind of across the street is, does this boom in activity on the trading side, on the investment banking side, continue? We've seen some momentum on the investment banking side. Trading came off a little bit, especially on the fixed income side of things in the third quarter at most every bank. So there may be a bit of a slowdown there. We've had 18 months, which have been just dynamite action. So I think you are seeing people start to prepare for a more normalized environment there.
Okay, another bank that is going through a huge restructuring, a bit like Credit Suisse, is Commerzbank. New management team coming in January, new CEO. Numbers today looking fairly solid. Let's take a listen to what the management had to say.
We stay cautious, as we have done over the past 18 months. So in the moment, we do not see anything, which is great. But I mean, what you currently have, and you can observe that some corporates are getting into difficulties because of the secondary effects. That is true for the resource constraints, which we see, but also the increased energy prices. And we should not forget that all the government support measures will end by 2021.
So loan loss provisions looking pretty good. That's certainly improving. It looks as if we may actually see a profit this year at Commerzbank. Remember, this is a bank that basically hasn't earned its cost of capital for a very, very long time. Michael, Manfred Knof came in January. Again, a turnaround plan. Is it working?
It seems to be they're taking the first steps. You know, I mean, 2020 was a bit of a kitchen sink year. They lost several billion euros, so had a lot of issues. So I think what you're seeing is steps in the right direction. They've obviously got a tailwind that many other banks have had of kind of they put aside a lot of money for the pandemic, and the economy's rebounded quicker than most of the banks expected.
Michael, thanks a lot. Really appreciate it. Bloomberg's Michael Moore joining us there on European banks. Coming up, OPEC Plus rejecting President Biden's plea to pump more oil. The delegates are worried about a surplus in the first quarter. We're going to break all that down. This is Bloomberg.
City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
Supply chain team's done a great job on semiconductors. We've been able to secure semiconductors for our entire business globally and been able to keep all of our installations globally, which we do almost 10,000 every day, somewhere in the world, all on track.
So we have a standoff between the United States and OPEC+. OPEC+ today announcing that it's going to stick with its plans for 400,000 barrels a day in terms of the oil hikes it's going to deliver. That was the plan, but remember, we've been getting calls from the United States, more importantly, calls from the president that actually OPEC should be delivering more oil, i.e. picking up the pace when it comes to production. Let's talk about what we've learned thus far. Will Kennedy, Bloomberg Executive Editor for Energy and Commodities, joining me now on set. Is it too far to go to say we have a standoff here?
I think, yes, we've got a firm no from OPEC to Joe Biden. They haven't done any of the things that he asked them to do, and they haven't actually offered many reassurances that they will even meet him a quarter of the way. So it seems to be a standoff, and the real question now is what will the US president do next? He said that he would respond if OPEC didn't come up with any oil, and they haven't. So attention on him. There's some speculation that he might turn to some kind of strategic petroleum reserve release and put oil onto market that way, but we'll have to see.
Yeah, but that's not going to really do anything, will it?
Well, it may do in the short term, but the problem you have, Alex, is if you do it once, and we're at $80, it's not super high priced by historical standards. If you do it once at $80, you've got to keep doing it, and, you know, a reserve only has so many reserves. So I think that it's a possibility and may help in the short term to ease some of the price rises that we've seen, but as a long-term strategy, it has severe shortcomings.
In a few minutes' time, we're going to be talking to Scott Sheffield, Pioneer CEO. Why is Biden not picking up the phone to him and going, "Oi, why don't you pump some more oil?"
Well, well, maybe he is, and maybe he's getting a more private no from him. We don't know.
We'll find out,
but,
shortly.
You know, but clearly, I think if I was the Biden administration, I'd make the following argument: is that shale is responding to their own supply, free market demand signals. OPEC is a group that is there to manage the market, a cartel in many people's eyes, and they are purposefully keeping oil off the market to keep prices higher. So I think you can see perhaps, or argue perhaps, that there is a difference between the two.
Okay, he doesn't say oi because he doesn't say that, number one. But number two, what I also found interesting, and I feel like this is why oil is a touch weaker after this, during this presser, is that you have OPEC Plus, you have Novak, Russia saying that they think demand is going to be weaker, and they're looking at the risk of a surplus in the first quarter. That's very counterintuitive to the majority of oil analysts out there. What do you think they see that a lot of other people don't?
Well, some of the recent demand has been driven by the broader energy country across the world, the lack of natural gas, the lack of coal, and that's clearly driven some people to use diesel as a heating fuel and as a fuel to generate energy. And I think a lot of people in OPEC see that as a temporary phenomenon to last through the winter. And then OPEC is scheduled to keep increasing production, and at the end of the winter you tend to get a seasonal slump in supply. So there is an argument that we will see a looser market in the early part of next year. Not everyone agrees, as you say, Alex, but that is the argument that OPEC will put forward.
How is the gas story impacting the oil story?
Yeah, as I said, it really is about looking elsewhere for energy. It sort of leaks from one energy market to another. You don't have enough gas, you turn to a cheaper source of energy. You use it for heating, you use it to generate at the margin through diesel generators electricity. So it is there, and if we have a cold winter in the Northern Hemisphere, that might become more pronounced. So it is a key consideration over the next few months.
Well, good stuff. Really appreciate it.
I think the president, if he was going to do it, would sort of lean forward onto the podium and whisper if he was talking to Scott Sheffield. But I'll leave it to Saturday Night Live to do a much better impression than me.
Well done. That and Avengers jokes. I don't know. I'm impressed with you today, Guy. Thanks, Will. Really appreciate it. Bloomberg's Will Kennedy. I also want to share with you and update you that you were looking at a live shot of House Speaker Nancy Pelosi holding her news conference. We are monitoring those headlines. If you want to follow along, just go right to Live Go on your terminal. This is Bloomberg.
Energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go to find answers now.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, what the challenges with getting people back into the workforce.
Let's check in on the Bloomberg First World News. I'm Ritika Gupta. The UK has rounded up about 20 nations to pledge to stop funding foreign fossil fuel projects. But the deal has a couple of key holdouts, those being China and Japan. A statement will be unveiled today at the UN climate talks in Glasgow. The agreement isn't binding, but it marks a further tightening of the flow of money from public development banks to oil, gas and coal. The US and Iran will resume talks November the 29th, aimed at reviving the deal that imposed limits on Tehran's nuclear program. The two sides don't speak face-to-face. They go through European and Russian intermediaries. There's skepticism that negotiations will be able to resolve differences over sanctions and the permanence of the deal. Volkswagen CEO Herbert Diess has told German workers that the new Tesla factory in Germany will threaten jobs. The electric car maker ramps up production at its first European factory next year. Diess urged VW workers to prepare for a deeper overhaul to remain competitive. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg Guy.
Ritika, well done. Thank you very much. Ritika Gupta with the First Word News. OK, let's talk more about what is happening in the car sector. Ford is announcing today the launch of an industry-first sustainable financing framework, guiding the company's investments in EV development and manufacturing. It's also issuing a new debt offering, which is going to have a significant impact on the company's cost of capital. Joining us now is John Lawler. He is the Ford CFO. John, thank you very much indeed for taking the time to be with us first. Let's deal initially with the impact that your debt restructuring is going to have in terms of your cost of capital. You're basically calling in old bonds, issuing new ones. How big an impact is this going to have? What is the new cost of capital versus the old cost of capital?
Well, we're going to take $5 billion of debt off our balance sheet, so we'll deleverage our balance sheet. High-cost debt that we put in place during the pandemic. And down the road here, you'll see us offering a green bond that will be, we believe, at a much lower debt. So when you take the net of those two actions, we believe the cost of that debt will be cut in half from what we have today. So this is a good step forward for us as a company. Deleverage our balance sheet, lower our debt, and puts us on a path that we're aiming towards to get back to investment grade.
So how quickly, John, do you think you can do that? When do you get to IG status?
Well, we're focused on what we can control. We can control the performance of our business and keep executing our Ford Plus plan, which you're seeing the results and the traction taking place when we announced our quarterly earnings recently. And we'll continue to focus on that. We'll focus on deleveraging our balance sheet, lowering our cost of debt. And the rating agencies then will take the actions when they see appropriate. So, as I said, we're going to focus on what we can control. We can't control what the rating agencies will do. We'll just keep performing, keep improving the business, improve our balance sheet, and we'll go from there.
As you say, John, you're going to see a significant reduction in the cost of capital. And as you also indicate, you are going to be issuing some green bonds. Talk to me about the kind of greenium that you think you will get as a result of going down that road. How big an advantage is there in going down the green route rather than the traditional route?
Well, we're seeing great interest by asset managers in this space, in the green space. And we have great opportunities to provide them with the types of financial tools that they would like to see. So when you look at it, we're spending $30 billion on our battery electric vehicles. And with this framework, we'll be able to directly tie the investments that we're making in vehicles like our Mustang Mach-E and our F-150 Lightning and our E-Transit electric van straight through to any financial instruments that we may put in the marketplace. So we've got great demand by asset managers. We've got a great platform to satisfy that demand. And we've got the investments that we're making in truly green initiatives that we'll be able to leverage. So I think it's a win-win across the board for everybody.
John, what kind of yields do you think you can actually get? Just give me a range.
So I think that we'll be able to take our debt down from what we see today, the high-cost debt in the 8% range, and potentially when we get out green bonds out there, we could be in the 3 to 4 to 5% range.
In terms of, can you just, you've provided some details, but I'm fascinated to see how this is actually going to work, the relationship with what you're doing, your production of vehicles, what you're doing on the environment, what you're doing on sustainability more broadly, what you're doing to help society. Can you just kind of give us an idea of exactly how this framework is going to operate? It's not just about building cars. This is a wider story than that.
Sure, it is. So when you look at our commitment, we've committed to the CO2 Paris Accord, where we'll be carbon neutral by 2050. We've committed to having 40 to 50% of our vehicles as battery electric by 2030, cut our emissions at our assembly plants by 2030 by 50%. But this initiative really does cover 4 key areas. It covers clean transportation, it covers clean manufacturing, it covers improving people's lives, as well as improving communities where we have our footprint. So there is a broad green as well as social component of this platform. And we really think that's going to be a positive for us with all the initiatives that are taking place through our ESG plans and our ESG programs.
Yeah, and then a 3 to 5% yield would definitely be a huge improvement from those pandemic bonds. I wonder, can you give me timing more specifically?
So we're going to put out the tender, as we said today, and we'll in the near term look at putting the green bond out there and issuing that in a short order. So we're very positive on where we think that could head. We're positive on the timing being relatively soon, and we're looking forward to seeing the demand and what can come through. Because again, I think we have a really good platform given the investments we're making in our green initiatives.
John, it would be remiss of us not to talk about what is happening right here, right now, in terms of the operational story that Ford is able to manage. Clearly, we've seen a huge rise in input costs. The chip story has been front and center. What are you seeing in the business right now? We're on a day-by-day basis trying to understand where the economy is, where the bottlenecks are, where they're starting to ease up. Are you seeing any signs of progress here? And if so, where?
So we're still seeing that, the supply chain is constrained. When it comes to semiconductors, I'd say that we're still, experiencing those constraints that we've seen throughout the year. We would expect them to continue through 2022. The fabs and foundries had started to put on capacity earlier this year, so we should see that capacity come online in the back half of next year and start to ease the constraints. So we're still seeing it. And as we said in our earnings call, we expect that next year on a sequential basis, what we can see is commitments today from the supply base, an improvement of about 10%. So we'll be dealing with this for a while.
John, do you have an idea of how this affects your inventory models going forward, rather than just in time? Is it going to be sort of, we'll stock up a little bit, rethink where and how we get semis?
Well, when you look at it, the just-in-time inventory process that we've really perfected in the auto industry may not be appropriate for capital-intensive, high-tech components, as well as components that are shared across industries. So we're taking a different look at how we would procure those and how we would design around those types of components, going down into the supply chain, securing capacity down in the supply chain, say at the fab level, and also designing for interchangeability and reuse across multiple vehicle lines or multiple components. So we're looking at the whole process around procurement and design and remaking that as we're learning coming out of this crisis that we've had with semiconductors.
Hey, John, thanks a lot. We appreciate it. John Lawler, Ford CFO, thanks for spending some time with us today. Coming up, Pioneer Natural Resources is shedding some assets, selling them to Continental Resources. Earnings are out. OPEC Plus does not give any more oil. U.S. looking at options. Will they talk to U.S. producers? We're going to break all of this down with Scott Sheffield, Pioneer Natural Resources CEO. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From London, I'm Guy Johnson. Alex Steele is over in New York. This is Bloomberg Markets. Alex, Pioneer Natural Resources, making oil flow, adding to shareholder payouts. Not entirely sure what that means, but it is also, and this is the critical bit, selling assets to Harold Hamm's Continental. Abigail Doolittle has the details.
Well, Guy, that is certainly a big deal there, that asset sale that was announced this morning. But Pioneer put up a great quarter, beating estimates on top and bottom. And this has allowed the company to raise the dividend. You can see here free cash flow. If we take a look going back to 2020, we have record free cash flow in the third quarter of more than $1 billion. Really pretty impressive. So they have raised the quarterly dividend to greater than $3 per share on a quarterly basis. That's incredible. That's a lot of money for a dividend to be netting. Now, you were just mentioning the energy prices and oil helping out. Take a look at this. This is really pretty interesting. So the average price for the barrel of oil equivalent in the third quarter, almost $53 relative to a year before, $28. Cost went up a little bit, but you can see that the gross is really incredible on a year-over-year basis, greater than double, $44.70 in the last quarter, really helping to explain that beat. And then in terms of that sale to Continental for $3.25 billion. Look at the strength here in the Permian, Alex. This is right up your wheelhouse, but you can see that the output is just incredible, up more than 130%, making it just a really rich area in terms of natural resources. Pioneer certainly benefiting from that.
All right, Abigail, thanks very much. Really appreciate that. Bloomberg's Abigail Doolittle. We welcome now Scott Sheffield, Pioneer Natural Resources CEO. Scott, good quarter. Congrats on the sale to some of those assets to Continental as well. So much to get through to. I just wanted to start specifically on the hedging situation, because you made about $52 a barrel in this last quarter, significantly higher than in 2020. Last time we talked, you intimated that around 80 or 100 you might think about hedging again. Have you changed that thought?
Good morning, Alex. It's great to see you again. Yes, on hedging, we are about 50% hedged for the second half of this year. Our hedges are pretty much rolling off. We're only about 15% hedged in 2022, and we've told all of our investors we are not going to do any more hedging, primarily with the Continental divestiture and the Glasscock divestiture, and by the end of 22 we'll be down to zero debt. So it's best, the best way not to hedge is to have the best balance sheet in the industry. So no more hedging, because I definitely think we're going to have a very, very tight market over the next several years.
So does that mean that we're going to see triple-digit oil prices then? Is that what you're kind of baking in?
No, I think oil is going to be in that $80 to $100 range. Oil is still cheap compared to natural gas around the world and coal. OPEC has done a great job balancing supply demand, but on the supply side, there's just not any extra supply. Demand is already coming back to pre-pandemic, pre-COVID. So there's about 3 million barrels a day less supply than there was 2 years ago. 2 million is U.S. shale, 1 million around the world. So that's why we're going to get into a very tight market over the next 5 years.
Let's talk one more about the nerdy stuff, as Guy calls it, the pointy-hatted conversation, and that's what has to do with cost. You mentioned that you're going to see about 5 to 10% cost inflation this year, 5% next year. 5% is about half of what some of your peers are looking at, significantly lower than Devon. Where's your biggest problem, and how do you fix it, and why is your cost inflation less than your peers?
It's prominent. We have a very large contiguous acres position, so a combination of our 15,000-foot laterals as a result of parsley and double point acquisitions. We're going to take over 80 wells next year and over 100 wells. 23 out 15,000 feet now. That's saving significant drilling and completion dollars. And also our contiguous acreage allows us to use the word simul-frac. We're fracking 2 wells at the same time. We'll be moving, we're now at 2 fleets. We'll be moving to a 3rd fleet later in 2022. So that's probably the biggest benefit we're seeing. Inflation costs are primarily on steel, cement are the major items, and labor.
That sounds like you're going to be pretty busy, Scott, and you're laying out the advantages of having continuous acreage. The consolidation story, and we've seen a little bit of, again, news on that front today. How far through that process do you think we are? You're basically laying out the advantages of it. Do you think we're going to see much more of it? Where do you think we are in this process?
Yeah, I think the second half of this year has been mostly in the Haynesville, maybe some in the Marcellus. So we're starting to see some gas consolidation. I still think it'll happen at a lower level. I think most of the great opportunities have been bought already. There's very little left. There's a lot more divestitures around the world, probably over 100 billion of divestitures that are available around the world, a lot by majors and so on. So I think most of it, you're going to see the good stuff has been taken, and you'll see a little bit each year as we move forward.
Simul-frac, that's going to be a word that Alex is going to use a lot. I'm telling you that here
so
and now.
True.
Simul-frac, yeah.
Simul-frac, yeah, sorry, my poor English accent. Let's talk a little bit about what the president's been saying. You mentioned OPEC up at the top. The president is calling on OPEC to pump more oil. My question, Scott, is why isn't he picking up the phone to you? Have you been talking to the president? Why is the president asking OPEC to pump when we have such great facilities in the United States?
No, I think the president is realizing all the efforts when he came into office of stopping offshore leasing, stopping drilling on federal leases offshore, New Mexico, both in the Bakken, in the Powder River. It's starting to backfire some. But at the same time, I don't think they realize what's changed in the U.S. is our investors want cash back. And so, as you saw, Pioneer, we're giving 80% of our free cash flow back to the investor. That's changed. And so our investors do not want us to grow anymore. And so he's got to change. If he wants us to change, he's got to change that investor mindset. And as you know, if we start growing too much again, we'll see a price collapse. It's happened too many times over the last 11 years. So I just don't see any extra supply coming on over the next several years.
So, Scott, is there anything else that DC could do to spur more growth from you guys? I'm thinking incentives, tax-wise, methane emissions are going to really hit the oil industry, sort of a cap on methane emissions. Is there anything ancillary that could get you guys going aside from shareholders?
No, I think he's got to back off his rhetoric on federal leases going forward, both in the Gulf of Mexico and both on all federal lands across the U.S. Secondly, we're 100% supportive of federal regulation of flaring and venting in the U.S. It's been a black eye for us for the last 3 years. When I came back about 3 years ago, I started speaking about it. So our flaring intensity is down to 0.2% of 1%. So it's the lowest in the industry, lowest in the Permian Basin of all U.S. oil companies. And so I'm glad that they're coming down harder. Now, right now, at higher oil prices, the small producer can afford to pay for this. In a lower price environment, he can't afford to do flyovers, methane sensors, vapor recovery units. But in a $80 plus market, I think the small producer can afford it also. So it's something that we need to clean up the industry and stop flaring.
Talking of which, Scott, one of the things that has come out of the COP summit in Glasgow is there is an increasing concern that the focus is going to be on public companies. And as a result of which, a lot of companies that are in the hydrocarbon business in the public markets are going to ultimately end up saying, enough of this, we're going to go into the private markets. Effectively, we're going to see them being driven from the public markets. Do you see that as a risk, and what would be the implications of it?
Well, obviously, you know, Continental, with Harold owning over 80% of his stock, it wouldn't surprise me if he goes private. He may be the first one to go private. But if you look at the capital markets and debt markets, I don't think anybody will fund a fossil fuel company to go private. So they essentially have to do it with their cash flow. So if you look at the amount of cash flow that we are putting out, I mentioned today on the call, 25 to 35 billion. If we wanted to, we could go private over the next 5 to 7 years. And companies may decide to do it that way by reducing their shares over the next several years. Right now, we still don't have investors buying these stocks. These stocks are trading at 4 to 5 times cash flow. I mentioned that we're number one on the S&P 500 next year at 11% yield. We just paid $880 million out this quarter to shareholders with an 8% yield. So we're still the highest on the S&P 500. We still don't have investors moving into this space yet.
Real quick, Scott, are you setting the stage to take your company private? Is that what you're doing right now?
No, it's an option for all of us. If we're all going to generate the type of cash flow over the next 5 to 7 years, it is one scenario that could happen if we continue to trade cheap in that 4 to 5 times cash flow. It's one option. So Guy brought up the private comment. I think they can only take, you can only take yourself private, not through the capital markets or through the debt markets. It'll be through the significant amount of cash flow that we reduce our share count over time.
Yep, I did ask Harold Hamm that once. I don't think he liked that question. Scott, thanks a lot. Really good to see you. Congrats on the deal, by the way. I loved chatting with you. Talk to you soon. Scott Sheffield, Pioneer Natural Resources CEO. Tune in later today for Commodities Edge. I'll be talking to Mike Sable, Venture Global LNG CEO. He joins me on his company's new long-term contract with Sinopec. Big deal. That's coming at 1 p.m. here in New York. This is Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's a simple, these are hard numbers. Your emissions are either A or B, they're going up or down, and if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
Today's $2 billion buyback is an important step, I think, and it shows confidence that we have in the underlying performance of the business and outlook, and shows a commitment to try and normalise our capital base.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
So nearly done, but let's talk about the next 24 hours. Today, before Alex says anything, we get earnings from Novavax. Yesterday I got this a bit wrong and she had fun with me. Expedia, Occidental Petroleum, Peloton, Uber. tomorrow, yes, European industrial production data for Germany, France and Spain. We're also going to get earnings from IAG. Alex, did I do okay there?
That was good. Thank you for reading the prompter correctly, Guy. And tomorrow, Excellent. Jobs Day. Very much looking forward to that labor force participation.
Is that all you've got to do?
That's all I got to do. Well, I'm going to tease. I'm going to tease right now.
Okay.
That wraps it up for me and Guy. Coming up, Stephanie Kelly, Aberdeen Standard Investments Deputy Head of Research, will be joining Balance of Power with David Weston on Bloomberg Television and Radio. And Guy, you get to go now.
We're going to go over to radio. We're going to go over to radio in an hour because obviously the time difference makes things a little confusing. But on the radio show tonight, we will be asking the question, is Andrew Bailey the unreliable boyfriend 2.0? That's coming up. This is Bloomberg.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images we can live the violent emotions of hell, the weight of purgatory and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside, so it's about using technology, pixels, and binary code with a human and humanizing content.
As the pandemic fades, will job restoration accelerate? Will a tight labor market push wages up?
I don't think we've ever had a hotter jobs market.
Tune in for the October Jobs Report, Friday on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
From the world of politics to the world of business, this is Balance of Power with David Weston.
From Bloomberg World Headquarters in New York to our television and radio audiences worldwide, welcome to Balance of Power. As Washington continues to struggle with President Biden's fiscal plans, Britain today took a surprising step when it comes to its own monetary policy, when the Bank of England surprised just about everyone by not raising rates, but keeping things just where they were. Our colleague Francine Lacroix sat down with the Bank of England Governor Andrew Bailey shortly after the decision was announced, and he said a lot of it had to do with market pricing and how it shifted over the course of the summer.
Market pricing, I think, as you could tell from the commentary we made, today, right direction, some bit overdone, but in my view, if you want a candid view. we have seen a correction in markets from the pricing we saw over the summer, particularly. And I have to be honest with you, I'm not surprised about that. It puzzled me at the time to see that pricing.
We will have more of Francine's interview with Governor Bailey coming up shortly right here on Balance of Power. But in the meantime, Britain may have its monetary policy set for the time being, but fiscal policy, as I said, in the United States remains very much up in the air in the aftermath of the elections on Tuesday. To take us through what comes next on Capitol Hill, welcome now our Washington correspondent, Emily Wilkins. Emily, thanks so much for being here. So I know we heard from Nancy Pelosi a short time ago, the Speaker of the House. Where are they on this Build Back Better and infrastructure packages?
So, David, what we've been hearing from Speaker Pelosi and Democratic leadership really all week is that they want a vote this week on both bills. That reconciliation package that has the social welfare, the climate, the taxes, and also that bipartisan infrastructure bill. But there's still a huge question this morning whether Democrats in the House actually have the votes to pass those bills. You've heard concerns from some moderate members saying that they need to take more time, really analyze what's in the bill, because while some of the stuff has been out here for months, some other provisions like dealing with SALT tax, immigration, paid leave, those are a little bit newer additions in language. We did see a score come out this morning showing that the bill is projected to raise $1.4 trillion in revenue. We'll see if that's going to be enough for some members, but talk has been swirling about the House potentially staying into the weekend to continue to work on this legislation. Lots of question marks about whether or not we're going to see a vote today or not. And
Emily, my understanding is that $1.4 trillion does not include projections the administration at least has for gaining more money through more IRS enforcement, so maybe a little north of there. But as a practical matter, do they have to take up the two bills more or less together? Because there's talk about separating them as well.
There is talk about that. Right now, the reason that the two bills have been tied together has a lot to do with the House Progressive Caucus. The caucus has stood really firm. They've said we need both bills to go at once. They're worried that if infrastructure goes first, they will lose the momentum needed to pass that other social welfare bill. So at this point, the plan is still to move both of those bills together. But Democrats are very cognizant that the election losses that they suffered this week perhaps could have been avoided if they wound up passing that infrastructure bill sooner. That's what we actually heard Speaker Pelosi say today. And so at this point, really, it seems like almost anything is possible, but we haven't heard anyone come out and say that the two bills will now be passed separately.
But as you say, anything is possible indeed. Thank you so much to Bloomberg's Emily Wilkins from Capitol Hill. We turn now to one of the members of Congress who will be deciding the fate of the Build Back Better and infrastructure packages. He is Democratic Representative Dwight Evans from Pennsylvania. So, Congressman, thanks so much for being back with us. I think you're identified with the progressive part of the party. Where are you on possibly separating these two, the infrastructure from the Build Back Better?
I'm ready to vote, David, and I thank you for this opportunity. I believe that the vast majority of members are also ready to vote and to get a message for the American people. At the end of the day, this is about the people, and I believe strongly that we will pass this tomorrow. I think you will see, I just came from a call because we had extensive discussions with all of the various committee members. And I can tell you that the members are ready to get it done, to get the action. In terms of the issues that have been important that we've been discussing, look, a message was sent last year. 81 million Americans voted for this agenda, and we're ready. We also won a state that we didn't win before. We won the state of Georgia. So I think it's clear in all the minds of people there that we're ready to take action and to send a message. And that, look, you had a little discussion, like in any process, you've been around through the legislative process, you're going to have that kind of discussion. And that's a part of it. So we've done it out in public. Now we're ready to take action and to move and to get the results that are building back better. The message that the president said, we're on board and ready to do it.
So, Congressman, that was very helpful, but I want to be sure I really understand what you're saying. When you're saying you're ready to vote, are you ready to vote on the infrastructure package if the Build Back Better is not ready, or are you linking the two?
We're ready to vote on both packages to get it done. The fact of the matter, this is long overdue. We need to get it done. And I know that you're trying to connect one to the other, but both packages are very important. And as the president said, it's connected to the president's overall agenda. And that's the important thing to recognize, not pit one against the other. The fact of the matter is we're all in this together for the sake of America. and we need to do it. So it's long overdue, and we need to get it done.
Yeah, please understand, I'm not trying to tie them together. It's just I've heard people tie them together. I'm trying to figure out what's going on. But let me ask you, we had some elections on Tuesday you might have heard a little rumor about, and some Democrats didn't do so well. Has it changed the calculus up on Capitol Hill at all?
I would say to you, no. This is about people. This is about American citizens, and there's things we have to do, like paid leave, child care. Those things are essential. Transportation, infrastructure, all those things are interconnected. And I think people know there's a job we have to do, and we are intending to do a job. There's an election every 6 months in America. So the fact of the matter is we're going to do what we're supposed to do, what we elected to. As you know, I'm on the Small Business Committee. I'm on the Ways and Means Committee. And we've gone through those processes, had all the hearings, all the information involved, and now it's time to get to work and do it.
Let me ask one specific question. That's about the so-called SALT, state and local tax limitation on the deduction there. That came out of House Ways and Means Committee. You'd have to go back in order to change it. Are you going to have even a temporary suspension of that, do you believe?
Well, I'm not sure on the language, but it will be addressed in some way. But I don't have the specifics for you. But the fact of the matter is we're not going to let any particular item hold up the passing this package. We're going to stay focused. We're going to get it done. And the American public is ready for us to get this done. You know the numbers and the polling information. All of the items are extremely popular. We need to do it and get it done.
All the items are extremely popular. And yet, as I say, on Tuesday, it didn't look like the American people were standing up and saluting, if I can put it that way. Do you think part of the problem was just sort of the inability to get anything done with Democrat on Democrat really disagreeing for an extended period of time?
Well, as you just said, look, the election is over. The decision is made by the people of the various states. At this point, this is about the entire country. We need to stay focused on this issue. We need to pass it. That's kind of where my focus is.
So you said, as I recall, that you think that we'll have a vote tomorrow. Are you fairly confident of that? And is that on both bills or on one or the other?
That's yes. I'm very optimistic. I'm going to say that I'm very optimistic, that we're going to vote. You could have Build Back Better today. As you know, they're going through rules discussion right now. Could have that today, but we definitely going to have a vote on these bills.
Well, isn't infrastructure ready to go right now? I thought that's been sitting there for quite some time. The Senate has passed it, hasn't it?
It's ready to go right now. So we can do it. It's a question of the call on the speaker. I think you heard from the speaker. The speaker has expressed it earlier. She's committed. All of us are committed, and we're ready to get it done.
Yeah, my understanding of what the speaker had to say, I was listening to her, trying to really understand what she was saying, is she said they'll have a vote, but only when she has the votes, I think, for both bills. Is that inaccurate? Is that what she's saying?
That's what the speaker has expressed. And, nobody's better than the speaker in doing the counting that she does. She does a very thorough job, and I think she knows and she understands it. She knows like anything. We need to get this done. She's clear about it. I'm supporting it. I'm supporting both bills, and we're going to get it done.
It needs to get something done, but it has to be something, I assume, that it can get through the Senate as well, right? It doesn't do much good if you pass something and the Senate just says no to it. So to what extent, as you think about the packages you're voting on and voting for them, are you thinking, is this something that the Senate will agree to?
Well, since I'm in the House and I can't speak about the Senate and what their action is, we will pass in the House, and hopefully everything will be worked out in terms of the Senate. But we in the House will do our part. The Senate will do their part. There's been discussions in terms of the various leaderships with the Senate, but at the end of the day, we have to take our step, and we need to do what we have to do.
Well, and I know that you as a congressman are just doing it because you think it's the right thing for your constituents and ultimately for the country overall. At the same time, we have to think about elections coming up. We do have a midterm coming up a year from right now. Once again, we had some sobering elections on Tuesday. If, in fact, and this is a big if, both these bills get enacted into law, do you think the American people will really focus on that or on the process of how we got there?
David, this is why I like to separate. I kind of separate it on what people need versus politics. The results of an election are over. We need to focus on the results in terms of addressing the issues that are important. There's a lot of poverty, particularly in my district in this country. We got to address our infrastructure is very important. We got to address paid leave. That's important. There's a lot of issues we need to address for the people. So there's politics. and then there's substance. And we need to stay focused in terms of the completion of this package. There's a lot of work that's going in this package. A lot of people have worked together, the president, the House caucus, the Senate caucus. But at the end of the day, we need to pass and get it done.
Well, it sounds like you've got a busy day or two or more in front of you, Congressman, so we really appreciate you spending some of your time with us. That's Pennsylvania Congressman Dwight Evans. Coming up, Stephanie Kelly of Aberdeen on the Fed decision yesterday, the jobs numbers tomorrow, and Build Back Better in between, perhaps. This is Balance of Power on Bloomberg Television and Radio.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. That does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating. I am no Sinophobe, very far from it.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of. Look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Bloomberg First Word News, we go now to Mark Crumpton.
David, thank you. And we'll follow up with your interview with Democratic Congressman Dwight Evans of Pennsylvania. House Speaker Nancy Pelosi is sounding optimistic that the chamber will approve both President Biden's social spending agenda and his infrastructure bill.
We're going to pass both bills, but in order to do so, we have to have votes for both bills, and that's where we are.
And the Speaker shied away from giving exact timing for the votes. Shares of Moderna are falling. The company lowered its estimate for 2021 coronavirus vaccine sales. Plus, it missed estimates for quarterly revenue and profit. Moderna is vying with Pfizer and BioNTech in a race to lock in orders for booster shots for next year. A chemical that causes cancer has been found in antiperspirant and deodorant body sprays. An independent testing lab is asking the Food and Drug Administration to recall all of the products with elevated levels of the carcinogen benzene. Products from Procter & Gamble brands, Old Spice and Secret contain the highest levels of the chemical. They're the latest in a string of aerosol products found to contain benzene, including sunscreens and antifungals. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thank you so much, Mark. The Federal Reserve surprised just about nobody yesterday with its decision to start tapering its bond buying, with Chair Jay Powell reassuring the markets as best he could. We welcome now Stephanie Kelly, Deputy Head of the Aberdeen Research Institute. Stephanie, great to have you back with us. So as I say, I think Chair Powell went out of his way to make things really calm and nice. Did he succeed?
Yeah, it seems like it. Markets have taken it fairly well. At the very margin, it was taken positively, and not hugely surprising either. As you said, the expectation was there for the tapering to begin, and the big question marks clearly in the conversation after the announcement, but also among market participants, is around when rates start to hike.
And that may be related, we heard from Chair Powell yesterday, to the employment situation. Tomorrow we get the jobs numbers for the United States. Give us a sense of how those two things relate. As we heard from Chair Powell, what has to happen with the jobs numbers for them to move as quickly or as faster in raising rates?
Yeah, absolutely. So we know that the Fed has a mandate both in terms of inflation, which we talk about a lot in markets, but also in terms of full employment and getting the economy to full employment. And those kind of dual interests are what make the jobs report so interesting tomorrow. I think in particular, it's the question we're most focused on and most interested in is how many people are coming back to the jobs market. We know that the demand for jobs is there. We've seen that through some of the survey data through the month. The big question mark is around how many people come back to the jobs market, because that's going to influence what full employment ends up looking like.
Yeah, and we heard repeatedly, actually, from the chairman yesterday about the problem with the job openings and the fact that we still have a lot of people unemployed and yet not people taking the jobs that are out there. So what sorts of jobs numbers would make a difference to the Fed tomorrow?
So I think this is where you can see, broadly speaking, the expectations, at least among market participants, around something in the half a million kind of space. But we know that those kind of numbers, the headlines, are in some ways, I mean, they're useful, but it's also important to see what are the trends underlying that. And I think, as I said, I think the question mark, as you pointed out, is why aren't people coming back into the labour market? Why have people left the labour market? And given that all that COVID support has fallen away, why now aren't people coming back? So we're hoping tomorrow to see signs in those elevated numbers that people are coming back into the jobs market, because that will take some of the pressure off Powell in terms of the outlook for full employment in the economy and therefore for rate hikes.
Well, and one question is whether the pressure should be on Jay Powell, the chair of the Fed, because it's possible that that's not within the Fed's power. That takes us back to Congress and this Build Back Better plan. What difference might that make in the economy overall and particularly in jobs?
Yeah, absolutely. So the Fed obviously just reacts to the employment market and acts through rates markets. And you're totally right. The government has a key role to play in terms of creating the demand environment to facilitate people going back to work. Now, some of the challenges around jobs mismatches and the effects of COVID are particularly tricky to solve. But I think the Build Back Better would allow a couple of things. First of all, it would provide key support in areas particularly pertaining to low-income households. We know they're the people who tend to spend more in the economy as a proportion of their total income. So those are really important programs to support the demand environment, because, of course, investors are always concerned about any risks you end up in this worst of both worlds with high inflation and low growth. And that's, I think, where it's helpful to have a government who's supporting the growth environment. And we hope to see that Build Back Better plan, see progress made on it.
Stephanie, one last quick one on a very big topic, which is inflation. We also heard a lot from the chair yesterday about inflation. As the practical matter, without a temper tantrum, is it possible that he's not really constraining inflation? Stephanie, can you hear me? I'm worried that we may have lost Stephanie Kelly. I'm so sorry. I had one more question, but we won't know the answer. We'll have to get her back and ask that question about inflation. But coming up right here on Balance of Power, we are going to get to hear more from Bank of England Governor Andrew Bailey about the bank's surprise announcement this morning that it will not be raising rates. This is Balance of Power on Bloomberg Television and on radio.
on Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference, this week on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Do you see Deutsche Bank ready to pay more and pay out more in terms of bonuses for staff to have that strong talent that I'm sure you want?
Well, look, it's a war for talent. It has been, in other cycles before. It is now. We're finding that we're competitive in that war for talent.
Gasoline prices are high because it's mixed with ethanol that went tenfold. Gasoline prices are high because there is low stocks in the U.S.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. The Bank of England surprised just about everyone today when it announced that it would not be raising rates after all. That was despite a range of indications that it would be raising rates. Bloomberg surveillance anchor Francine Lacqua sat down with BOE Governor Andrew Bailey after he announced his decision.
I don't think it's our job to steer markets day by day and week by week. Take the statement I made a couple of weeks ago. As a number of people raised, we make a lot of conditional statements, rightly so, because obviously, a lot of our statements are, well, if the following thing happens, then it will lead to the following. And it was a very clear statement by me that if we saw evidence, particularly that medium-term inflation expectations were becoming de-anchored, then we would have to act, and we would act. Now, that's a conditional statement, but of course markets have to translate that into unconditional actions. I will understand that. By the way, I would also add that I think over the course of the summer, we were observing evidence, obviously, of rising inflation pressures. We had some language in various of our publications suggesting that there would have to be, I think we used the word modest rise in interest rates. Interestingly, we were observing market rates coming down. You look at 10-year government bond yields, both, not just here, actually, because in the US as well, for instance, coming down as this inflation pressure was growing. So we were a bit puzzled by that, frankly, and perplexed. And there came a point where I think we have to increase the sort of, in a sense, increase the volume of the message, and that was deliberate on my part, because I was concerned that we could see, obviously, the rising inflation pressures. Now, I think you're right that today, two messages. One, we expect there will need to be a rise in interest rates. Two, however, because we condition our forecast on the market curve, as I did point out, our forecast suggests that by the end of the forecast period, 3 years away, inflation was coming a bit under target, probably on a declining trend, and we had an output gap opening up, and obviously that wouldn't be what we were wanting to see.
Governor, if we can go back to markets, it was this we will have to act that at the time seemed pretty hawkish.
Yes. So
again, why did you not temper it, or did you actually at the time, weren't not enough worried about growth?
No, it's a statement. And by the way, it's a statement I hold to today, which is that, of course, in those conditions, particularly if we're seeing, inflation expectations beginning to become de-anchored, we will have to act. There's no question about that. I don't resolve that one bit.
But so did the markets misread you? Is there a communication problem?
No, I don't think they misread at all. What I would say, however, is that nobody in the Bank of England, me included, said, therefore, there will be a rise in interest rates in November. That was nothing. We've never said that. Now, actually, interestingly, I think Bloomberg, you published your economists survey, yes. And it was pretty evenly balanced on what we were going to do today.
But the markets didn't. So do you think you've lost credibility with the markets?
But that's the interesting thing, isn't it? That we pick up quite a lot of commentary which matched your survey. So a lot of people said to me, a lot of people were saying to us, it's pretty close. And you know, my view would be, yeah, it was pretty close. It is a very, very finely balanced situation. Now, you know, market pricing, you know, I think, you know, as you could tell from the commentary we made, you know, today, right direction, some bit overdone, but in my view, if you want a candid view.
That was Bank of England Governor Andrew Bailey speaking to Bloomberg's Francine Lacqua earlier today. Coming up tomorrow, we're going to hear from the former BOE governor, Mark Carney, on Wall Street Week. He's going to be talking about his new efforts to put together a coalition of financial institutions to fight climate change. Coming up here, the U.S. mixes trade policy with climate policy. We talk with former Deputy Secretary General of the WTO, Rufus Yerxa, about how that will work with the steel and aluminum tariffs. This is Balance of Power on Bloomberg Television and Radio.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Balance of Power on Bloomberg Television and Radio. I'm Guy Johnson. European equities are about to wrap up the day. Let me bring you the action and what we've seen. At a headline level, not really much to talk about. As you can see by the map, broadly, Europe is higher. We continue to inch ever upwards when it comes to the stock markets, and we can continue to take out records. But it feels very incremental at the moment. FTSE 100 up by around 0.5%, the CAC up by around 0.5%, the DAX up by around 0.5%. Those are the main markets. But in some ways, the story today has been outside of equities. There are some individual names, which I'll focus on in just a moment. But what we just heard from the Bank of England Governor, Andrew Bailey, absolutely fascinating. He is now being labelled the unreliable boyfriend 2.0. Remember, that was originally originally a criticism pointed at Mark Carney that he talked a lot and then didn't deliver. Well, Andrew Bailey, some people would argue, talked a lot and then didn't deliver. And you can see that today in the reaction that we're getting in the markets. The cable rate, the British pound versus the US dollar, down by 1.34%. The repricing that we are seeing in the gilt market today is absolutely eye-watering, particularly at the front end of the curve, where we have seen a huge bid come back into two-year gilts, yields significantly lower, a real communication problem at the Bank of England. So the stock 600 up by 0.4%. We got a gap higher first thing this morning. We've pretty much gone sideways since then, but 483 fresh records continue here in Europe. Let's talk about the breakdown and where we've seen the action today in terms of the individual sectors and stocks. Let's start with the sectors. Real estate absolutely flying. Brookfield of Canada looking to buy a German company. It is Austria AOX, and we've seen a huge bid premium coming into there, and as a result of which that's lifted the whole sector. I'll talk about the stock in a little bit more detail in just a moment. Technology is up. Bottom end of the market, the banks. It's the British banks that are doing the damage here. Unsurprisingly, as you see this huge move in the rates market as yields come lower, bad news for British banks, great news for the house builders. They've been really catching a bid here today. Lower rates make it easier to buy houses. So let's talk about some of the individual names, talk about some of the stock stories we've had, the single stocks. Credit Suisse out with their new strategy review. They're getting out of the hedge fund business, effectively the prime brokerage business, and they are pointing themselves firmly in the direction of wealth management. But we still haven't drawn quite a line under the Archegos crisis. That's still going to have an impact in terms of the profitability, and you can see that reflected in the numbers. Metro Bank, though, UK bank, challenger bank, looking like it could get a bid from Carlyle. That's interesting. So M&A in the banking sector here in Europe. Metro Bank up by 30%. And I mentioned that Brookfield's bid. Austria, this is a REIT based out of Germany. Huge amounts of consolidation taking place in the German office market, the German property market right now. They've come through at 1950, so we're right on that. That's where the offer price is. So the market certainly sees that one happening. David, back to you.
Thank you so much, Guy Johnson, for that wrap-up of the European markets. We have banking, we have real estate. What more can you want? Well, we're going to stay with Europe, sort of, right now. In announcing the easing of steel and aluminum tariffs with the EU this week, the Biden administration added a new twist, seeking to use trade policy to reinforce its efforts to curb carbon emissions around the world. As Secretary of Commerce Gina Raimondo explained to us.
We're going to work in earnest in a defined period of time to come up with a global steel arrangement that preferences clean steel. So that actually takes into account the carbon intensivity of steel, which will, of course, benefit the U.S., which makes the cleanest steel in the world, and the EU. And it is designed, to block China, which continues to make very dirty steel.
We welcome now Rufus Yerxa, who served as Deputy Trade Representative to the United States and then went on to be the Deputy Secretary General of the World Trade Organization. Rufus, thank you so much for being here. So you heard it right there. You almost had everything if you're interested in trade. You've got steel, you got the United States, you got Europe, and you've got China, not to mention carbon emissions. So what do you make of this new deal? Is it likely to really have an effect on carbon emissions?
Yeah, great to be here with you, David. And, first of all, this is a significant shift from the Biden administration away from the more hostile policies towards Europe that Trump had maintained on trade. And, it's obviously unwelcome news to the steel industry because they wanted to maintain a sort of global restraint system to keep the U.S. prices high. But it's great news for all the downstream industries, from autos to chemicals and agriculture and everybody who rely on steel, and also those who are exporting to Europe, because the Europeans will now eliminate the retaliation. The bigger picture is that it will enable the U.S. and the EU to work together on a whole host of issues in a more collaborative way, to take on China's non-market economy practices, to deal with climate change, as you heard Secretary Raimondo just say. This doesn't rule out the need for some kind of carbon-related tax and trade system that will, I think, emerge long term. But for the U.S. and the EU to be able to do that in more of an alliance, I think the name of the game now is how can the democratically elected market economies get back to a world where we're pressuring for both better trade rules and, a good outcome on climate change. And I think this is a big win for the Biden administration. It's welcome news to most of the manufacturers in the U.S. It really reduces the kinds of impediments that this trade war with Europe created.
So, Rufus, I'll confess, I had certainly thought about the U.S. enlisting allies with respect to dealing with China. We heard about that from President Biden now. Around national security and around, as you said, the nature of their economy and the subsidies they provide. I had not thought about climate, though. Is this something that we can really agree with our allies about and really not isolate, but really deal with China more aggressively on? Because China has a lot of problems themselves when it comes to carbon.
Yeah, I mean, look, the U.S. is still a big carbon emitter, too. And we've hardly, the domestic debate on how to tax carbon in the U.S. is still going to be a very contentious thing going forward. But ultimately, certainly to concentrate on clean technologies, on moving towards lower carbon emission, towards alternative forms of energy, and towards actually the reduction, ultimately, of the use of heavily polluting products like steel and cement and other things, and moving towards, more carbon-friendly forms of manufacturing and production. But clearly, China has started moving in that direction, but still is a great big emitter and has a long way to go, and in sectors like steel. So the news that the administration is going to try to work with Europe and probably with Japan and other Asian countries as well, and with our North American partners in developing a model that could get us towards some kind of cap and trade kinds of solutions that would reduce the carbon intensive types of production.
So to many people, this sounds pretty good. I mean, you're talking about carbon taxes, carbon pricing, presumably border adjustment tax based on carbon. That sounds like it'll be good for the environment. But as good as that sounds, doesn't that have a lot of disruption involved? And let me be frank, increased prices. Doesn't that mean our steel is going to be more expensive?
I mean, I don't think you're going to move to a regime like that overnight. It's going to take a long time to play it out. The big question is, as countries adopt these systems, can we do it in a way where we don't turn it into huge trade disruptions with a lot of tariff systems and uncoordinated actions by governments? But I agree with you. The domestic debate over how fast to move on, towards alternative forms of energy, towards lower carbon emissions, towards how do we bring about those changes in our own industries, which the Biden administration wants to do more with kind of subsidy programs. And certainly Republicans will oppose, new forms of taxation of these carbon intensive industries. Others have moved towards that. I mean, Europe does have a permit system now that it's putting into place for, highly carbon intensive industries like steel and cement.
So let's go back to your old organization, one of them, the WTO. As you correctly point out, once you get to tariffs and taxes, you can have wars going on between countries when it comes to trade. What is the role potentially of the WTO to avoid that, to make sure it is coordinated, that in fact we are accomplishing goals that we claim as a globe we want to reduce carbon, and yet it doesn't give a rise to competition on that issue among countries?
Well, it can be used for that purpose, David, if governments have a commitment to do that. I mean, on everything from, how you tackle global pandemics and health challenges to obviously issues like the environment and climate change. It does provide a forum for how you negotiate in a whole host of areas, subsidy practices, intellectual property, a whole bunch of things. But the governments have to be on the same page about what their goals and objectives are. They may have different positions and different means, but the broad goals have to be shared. And that's the big challenge in the WTO system now, David, is that I think you will see emerging kind of two divergent approaches to government intervention in the economy. I think, the U.S., Europe, other more market-oriented countries will want to rein in, a lot of forms of state control and state subsidies, while at the same time maintaining room to do things like subsidize clean energy and other things. China will challenge that because China is intervening in many different aspects of its business life. And so the challenge will be, can we get on the same page? Can we negotiate with China in the WTO to create multilateral rules? Or do we end up with different approaches and a two-tiered sort of system in the WTO. That's really the challenge of the future for this administration and probably many administrations to come.
Rufus, as always, this has been very, very helpful. Thank you. That's Rufus Yerkes. He's former WTO Deputy Director General. Coming up, the British Ambassador to the United States, Dame Karen Pierce, joins us on the results of COP26 and U.S.-UK relations. This is Balance of Power on Bloomberg Television and on radio.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now.
Wrap it
It's a weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
Проходим опасный участок, ответственный. Ну что там, поднимаете на Жумаре, шерпа страхует.
Очень много думал о том, что я сделал, и понял, что сделал какую-то нереальную вещь. Не знаю. Я до конца внутри себя даже не могу поверить, что я через это прошел. Состояние, наверное, организм истощен, потому что очень много физической работы. Своим вот этим поступком я хотел сказать, что только через действие в этой жизни достичь можно абсолютно всего.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Great Britain has just finished hosting the COP26 summit in Glasgow, with Prime Minister Boris Johnson playing a leading role. Welcome now his ambassador to the United States. She is Dame Karen Pierce. So, Dame Karen, thank you so much for being with us. Let's start with COP26. Give us your perspective and the British perspective on what came out of COP26. How are we farther ahead today than we were before?
Well, we owe a great thanks to India, thanks to President Modi's commitment. Some 90% of the global economy is now covered by a net zero commitment to 2050. So that's up from some 30% when Britain took on the role as COP president. So that's a huge step forward. We have provided some $500 billion over the next 5 years in financial instruments and help for developing countries so that they can unlock climate finance instruments and so that they can do the adaptation and resilience required. We have got a very good agreement on deforestation to end deforestation within, I think, some 10 years. And we have got a lot of progress on financial services, what we're going to do in the G7 to have market sustainability and to have mandatory reporting around climate factors and embed risk factors from climate into things like audit. And most of all, I think we have changed the narrative. This is 5 years on from Paris. We've got a step change in the level of ambition, but also of targets. And I think this means the next 5 to 10 years, as we implement all these commitments, we're in a much better shape than we would have been a year ago.
Yeah, I must say, Madam Ambassador, I'm impressed at least by the list of commitments. But as you just said, now we need to move to implementation. Let's talk about some specifics on implementation, and specifically with respect to the United States and the United Kingdom, if I could. As you know, there was a new arrangement announced between the United States and Europe with respect to steel and aluminum that specifically included some carbon issues in it, saying basically to encourage low-carbon steel. Tell me about our relations with the United Kingdom right now on carbon. Is it likely we could have a similar sort of deal?
Well, we were very encouraged by the statement that came out of the administration at the weekend after they'd reached the deal with the EU. There was a statement about the UK, a statement about Japan. We very much look forward to being able to begin our own talks with the administration on these issues, on the steel aspects, on the low carbon aspects, but also on the tariffs overall. You know, we're a great free trading nation. We like to think of ourselves like that. We would want to see all the tariffs removed between us. We hope we'll be able to start those talks soon.
So, as you know so well, the arrangements between the European Union and the United States were something called tariff rate quotas, which is sort of a managed trade. You don't pay tariffs if you're under a certain limit. From what you just said, are you averse to that? Is that something the United Kingdom would prefer not to do?
I think in general terms, a nation like the UK, we don't see tariffs in the same way as America has historically seen tariffs as an instrument of trade policy. We would prefer to remove the tariffs that we both placed on each other in the wake of the steel dispute. I was recently in Kentucky and Ohio looking at the bourbon and whiskey industry. I know they feel the effect of UK tariffs very keenly. At the same time, we believe that our steel, we account for less than 1% of US imports of steel. Our steel manufacturers, our steel is no threat to the American industry, and we do hope for the tariffs to be removed on both sides soon.
These diplomatic negotiations take whatever time they take, but do you have any sense of a time horizon for the US and the UK when it comes to steel, when we might have some resolution?
No, we haven't put a timeline on that. I know a lot of people compare it to the large civil aircraft, the Airbus-Boeing dispute. But in fact, that had a different rhythm, and we'd started talks before the EU and US talks were over. So I don't want to put a timeline on this, but we do hope we can start soon. There are a lot of trade and economic issues we look forward to discussing with the administration. We would like to get back into a situation where we can get into the free trade agreement that we had going, and we'd like to also talk about things like Build Back Better World, supply chain resilience. How are we going to manage all these issues in the wake of COVID as we try and get our economies moving?
So, Dame Karen, let me ask that question specifically, supply chains, because they're so important in the United States right now. What can the United States and the United Kingdom do together to address supply chain issues?
Well, we're working very closely in the G7 to look at resilience, to look at reliability, to look at what products are most critical for the various areas we have to work on. Medicine is an obvious area here, and we are hoping to get agreements among the G7 that will make this issue much less acute in the future. If you're a country as large as the United States, you can do a lot of reshoring of your your supply. Europe, the United Kingdom, we work in a different way. I think there will be a lot more reliance on allies and partners, but we also want differentiated supply chains. We don't want to be locked into a situation where we're very dependent on one supplier only. All these things are going to be looked at, are being looked at in the G7 context.
Madam Ambassador, a different subject, but one that the United States and the United Kingdom have worked on, and that is Iran. I know there are negotiations starting, I believe it's November 29 now, with Europe and the United Kingdom will be involved in those. Do you hold out real hopes for progress this time? They've been very difficult so far.
Excuse me. Well, we hope so. One should never count one's chickens before they're hatched. As you say, the Iranians are coming back to the negotiating table. Britain, France and Germany, along with the US, Russia and China, chaired by the European Union, will be all sitting down on November 29th. These are very important things at stake. The Iranians have been moving further and further away from compliance with the nuclear agreement. We do want them to come back. We also want them to get into more detailed talks with the International Atomic Energy Authority on verification. So there's a lot to do. I don't want to preempt what might happen, but we very much need to find a way forward.
Yeah, and I certainly don't want to preempt it, but one last question on this, because you understand the situation so well in the United States. It is not a permanent agreement because it wasn't ratified by the Senate. How important a roadblock might that be to getting Iran to come back and really enter into a new agreement?
I think you will find that one of the things the Iranians do talk about is whether or not, if America makes new commitments or returns to the existing commitments under the JCPOA, the nuclear deal, what confidence do those negotiating with America have that those deals will stick? I think that's a legitimate question. I think President Biden has sought to answer it and to give an assurance that if America makes commitments, they will endure. But I think overall there's something important about the lasting nature of the agreement itself. If we can get back into the nuclear agreement, it benefits both sides, and that mutual reciprocal benefit is what I think keeps these agreements moving.
Are relations between the United States and the United Kingdom stronger or weaker than they were 5 years ago?
Oh, I think it just keeps going from strength to strength, to be honest. What we're trying to do now is we have this very solid bedrock of defence, security, foreign policy cooperation. We have really good people-to-people links. There are all these new areas like climate, like new technology, new disruptive technology. We are looking at how we can best strengthen the partnership between the UK and the US in these new areas as well, to complement the shared endeavours that we've had so far.
Madam Ambassador, thank you so much for being with us. You're always welcome here. We want to know what's going on in the relations between our countries. That is Dame Karen Pierce. She is UK Ambassador to the United States. And this is Balance of Power on Bloomberg Television and on radio.
van en contramano de lo que dicen la comunidad científica y los territorios que están en lucha. Han profundizado el extractivismo en Argentina con más agronegocio, con más transgénicos, con más agrotóxicos, con más proyectos megamineros, y ahora, como si fuese poco, han avanzado presentando un proyecto de ley que es la ley de hidrocarburos.
111 million people use Twitter every day all around the world. 20% of those are in the United States. The top of funnel is really healthy. So we get a lot of at-bats, and we just need to keep doing a better and better job of converting people to help them make Twitter part of their daily ritual.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Check out the Balance of Power newsletter on the terminal and online. Today's top story focuses on the return of oil, of all things. That's despite all this talk about going green at COP26. Coming up, Balance of Power is going to continue on Bloomberg Radio. In that second hour, we're going to talk with former HP CEO Carly Fiorina and also Professor Julia Sass-Rubin from Rutgers on Governor Phil Murphy very, very narrowly winning a second term in New Jersey. This is Balance of Power on Bloomberg Television and on radio.
Engine number one was able to do on the Exxon fight. It opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm Alex Steele. Welcome to Bloomberg Commodities Edge, where we focus on the companies, physical assets, and the trading behind the hottest commodities with the smartest voices in the business. All right, let's get right to the data dig, the top market stories of the week. So just today, OPEC and its allies sticking to their slow pace of oil production increases, totally disregarding President Joe Biden's plea. They're going to stay with the 400,000 barrels a day, a hike in December, and the U.S. is considering how to respond. But what's really interesting is this next chart. So since May, the group's output has actually fallen behind its own target as more and more of its members struggle to add supply. They're now pumping about 700,000 barrels of oil a day less than promised in September. And today, OPEC Plus said they wouldn't make up these shortfalls in their December production. Another highlight this week was the crazy ride we saw in wheat. I mean, at point, it hit the highest price in about 9 years. The UN cut its wheat stockpile estimate today. Smaller crops, strong Middle East demand, and a pretty mixed bag on planting conditions north of the equator. Your breakfast is definitely costing more. And one more thing to keep your eye on here. You got short-term contracts in copper, once again trading at a premium to futures over in London. That's that orange line here. Future prices are trading a little heavier on weaker demand and China worries, while you got spot prices rallying as inventories at the LME continue to stay at multi-decade lows. That backwardation looking pretty sticky. Now let's get into the ring, because you got the world versus methane. President Biden spoke about the importance of limiting methane leaks at COP26.
This isn't just something we have to do to protect the environment and our future. It's an enormous opportunity for all of us, all of our nations, to create jobs and make meeting climate goals a core part of our global economic recovery as well.
And one of the bright spots of the Global Summit was the Global Methane Pledge, a collective commitment to cut gas by 30% by 2030. And that was signed by more than 80 countries. And as you can see here, it's one of the biggest things the governments can do to keep alive the goal of limiting global warming to 1.5 degrees Celsius above those pre-industrial levels. And this all brings us to Commodity in Chief, where we talk to one executive in the commodity world. Today, it's Mike Sable, Venture Global LNG CEO. Now, natural gas is playing a key role in this energy transition. Just look at the energy crisis right now in Europe and the UK. And now countries are starting to sign up again to large, long-term LNG contracts. The latest, Unipec, the trading arm of Sinopec, is buying 3.5 million tons a year from Venture Global from its Cachalou Pass in Louisiana. And this is after it already agreed to buy 4 million tons a year from its proposed Plaquemine facility in Louisiana as well. Mike joins me now. All right, Mike, how did this deal come about?
Hi, Alex. Great to be here. Well, I mean, it's an end of a long effort by the team to really deliver great value to the customer, which generally in the commodity markets is a great price. So it's a competitive landscape out there, and for the long-term contract, the 20-year contracts, it's what we focus on. It really is about delivering great risk-adjusted price and the customer being confident that you'll get it done on time.
So the 20 years, I mean, I actually am a little surprised because I feel like the path of least resistance was the spot contracts, no longer these 20 years. Do you think the energy crisis right now played a role?
You know, maybe a little bit, but not really. We've been focused exclusively on the 20-year contract part of the market, and there's a segment of the market that wants those 20-year contracts. And really, it's the rest of the market has moved away from us as we've been winning on price. And for the last 4 or 5 years or so, Venture Global has won about 90% market share on 20-year contracts coming out of the U.S.
Where are you going to be looking at next?
We are confident that we are finishing up sales on Plaquemines, which is a 20 million ton facility on the Mississippi River, and we have 2 other projects, Delta on the Mississippi next to Plaquemines, and CP2, which is an expansion next to this facility that you're looking at right now in the video, and so CP2 and Delta are coming next.
Hey, Mike, talking about Plaquemines for a second, what percentage do you have sold right now, and how quickly can you sell the rest?
So Plaquemines is a 20 million ton facility that we're going to build in 2 phases. We have 9 million tons sold there, and so we're moving towards FID on Plaquemines in the next few months, and then the second phase will probably be mid-year. So we'll be in construction for all 20 million tons in 2022.
Oh, wow. Wow, okay. And what about Delta LNG? There was Hurricane Ida. I'm wondering how you were impacted there.
We had very minimal impacts on our Plaquemines facility from Hurricane Ida. We have a little bit of localized flooding, but nothing that's going to impact our schedule at all. So we were fine there.
So then circling back, so then those are all the areas that you're looking at, that you're hoping to build, et cetera. Cashaloo, like I mentioned, it had that agreement now with Unipec. I'm wondering when you might actually start shipping. I mean, the market is so thirsty for this tonnage.
Yes, no, that's the billion-dollar question. We are actually just very recently, and it was kind of disclosed in the press earlier this morning, FERC gave us authorization to commission our first liquefaction train at Calcasieu Pass. And so our commissioning is moving along very well and on plan. I would point out we're very proud of this because of how we uniquely configured and execute our facilities, that even with the global pandemic and a couple of hurricane strikes, we're on our original schedule. And that's because we manufacture so much of our process system in factories in a way that no one's ever done before.
Meaning that you make them over in Florence with Baker Hughes, it's a modular situation, then you bring them over and kind of just like plop them down in Louisiana.
Baker Hughes has done an amazing job for us working through the COVID and delivering on all their schedules and budgets for us.
Okay, so I still want the timeline, Mike. When are you going to start shipping? End of the year? Before the end of the year?
I'm being a little bit careful because we have $2.5 billion of public bonds. There are securities here, and so we are very close. But I'm not allowed to break news on exactly what a specific schedule is. So we are. I can say just a few months away.
That's really exciting, Mike.
Yes.
More specifically, how many modular trains do you now have installed, and like how many more do you need to go?
So we have 18 liquefaction trains. We have 16 of the 18, and our 17th and 18th train are actually arriving within days.
Oh, wow.
They're on the ship and they're about to be rolled onto their pads, and we're mechanically complete for our first 8 liquefaction trains. So we're in a very good position on our delivery schedule.
So most everyone I'm going to talk to in the energy world is looking at rising labor costs, rising raw materials costs, and rising shipping costs. Have you had any of that, or did you mitigate it?
There's a little bit, but our approach again mitigates it. We fabricate and manufacture our process system largely in factories, and we have much of that under long-term contracts. And it also reduces the amount of labor. So instead of 13 to 15,000 workers custom stick building our projects, we're going to average about 2,000 people over the life of our construction, and so we have much less labor exposure, and we have some long-term contract protection related to some of our commodity exposure on inflation for steel, aluminum, copper, and other materials.
Without giving away the farm here, can you give me some insight into what other companies and countries you're in talks with now? The focus has really been on, say, the UK and Europe and the energy crisis there. Are you sticking more to Southeast Asia and Asia? Where are you having your conversations?
No, it's actually a fascinating question. We are doing well both in Asia and in Europe. And we continue to have some nice surprises in demand in Europe. Of course, very recently, just in the last couple of months, we announced a major expansion of our deal with Poland. And Venture Global is going to, when we're complete with construction, going to be supplying about 30% of the gas supply to the country of Poland.
Oh,
Poland
wow.
has done an amazing job of preparing themselves to pivot away from coal. And just like we just announced with Sinopec in China, and they're following a very similar path, which is a very balanced approach to mitigation of massive CO2 emissions, but also reliable baseload, secure, low-cost energy supply.
Mike, it's so good to see you. Congratulations. I know it's been a long time coming today. Mike Sable of Venture Global LNG, thank you so much. Good to see you. All right, time now for our commodity kicker. McRib lovers, brace yourself. McDonald's Colt Barbecue Sandwich is back on the menu. And this year, the slathered pork patty can stick around in more than just your arteries, because the fast food giant has now created a digital McRib in the form of an NFT, or non-fungible token. There are 10 Forever McRibs that will be randomly raffled off to fans who enter the contest. Winners, take heed. You make sure you come prepared with your crypto wallet. Yeah, I just don't get that one. All right, that does it for Bloomberg Commodities Edge. Catch us every Thursday at 1 p.m. in New York, 6 p.m. in London. This is Bloomberg.
When you use Ecosia and click on it, we make money. But now there's a big difference compared to other search engines. We use the money to plant trees all over the world where they are needed most.
On Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference, this week on Bloomberg Television and Radio.
Welcome to Bloomberg Markets. I'm Matt Miller. Coming up this hour, we're going to speak to the Cars.com CEO, Alex Vetter, on the back of that company's earnings results and supply chain woes. Later in the hour, I'm going to talk to the CEO of Ovintiv, Brendan McCracken, as OPEC Plus rejects President Biden's plea for supply increases. And the CEO of Vici Properties joins us to discuss the slate of deals changing the ownership of the landscape, well, changing the Las Vegas Strip. Let's first take a quick check at what's going on in the markets right now. Another new all-time high on the S&P 500, gaining 0.25%, almost 12 points right now to 46.72, and it has been up a little bit higher today. The U.S. 10-year yield coming down as investors buy government bonds. So 152.97 there the day after the Federal Reserve, and that is pretty interesting. Here we see back again. The dollar index up about 0.5%, 11.64, and Brent crude down 37 cents to 81.62. That is a small move considering the big news that we have from OPEC Plus today, and we're going to get to that throughout the program. I want to get right now, though, to something that caught my eye, and that is the Bank of England. Earlier today, it defied market expectations by keeping rates on hold. That's what you saw here just a moment ago. Policymakers led by Governor Andrew Bailey voted to keep the benchmark rate at 0.1%, prioritizing immediate concerns about slowing growth more than inflation. Officials also pushed back against the market pricing for a series of hikes, all the way up to 100 basis points, 1 full percent next year. The pound weakened after the decision. That's why we saw the dollar a little bit higher, hitting its lowest level since the end of September. Here you see cable right now trading at 134.87. Sticking with or maybe moving to Europe. Credit Suisse was the biggest European player in the prime brokerage industry until a series of risk management failings led to a $5.5 billion loss on trades with Archegos. Now it says it will largely exit that business. And as you can see here, that opens the door for more U.S. heavyweights like Goldman Sachs here and Morgan Stanley here to take market share away. My colleague Francine Lacroix had an exclusive interview with the CEO of Credit Suisse, Thomas Gottstein, and the chairman, Antonio Orta Osorio. Gottstein spoke about leaving that business.
We have made some tough choices, like exiting Prime, but at the same time, we have strong businesses like in M&A capital markets, in credit, and in other areas. So, as you also saw in the third quarter results, we had very strong increase in revenues in these areas, including in also equity derivatives. So our plan clearly is to have an investment bank which has less capital, which is much more connected also with the wealth management area. And has also continued strong global franchise, and that's why we have also decided to have one global investment bank. So we included not only Asia but also Swiss Universal Bank, and this is very important for us because as part of our strategy to have strengthen the bank, to simplify many of our areas, but also to invest in growth. And we want to invest in the investment bank, be it in capital markets, be it in M&A, be it in all the other core areas.
How do you avoid the slippery slope of actually getting smaller?
Well, this is something that we have, I think, managed very well. If you look at our 9 months numbers, we are actually, despite having done already a significant reduction in capital in the second quarter, we are up significantly in terms of revenues, and that continued in the third quarter. And it's clear that the exit of Prime will have a short-term restructuring effect, but the areas where we want to focus on are growth areas and where we see competitive advantages, where we have strong positions, and where we continue to invest. And I think together with the connects with the wealth management area, whether it's in trading, whether it's in M&A capital markets, we have significant upside.
And that was Francine Lacroix speaking with the CEO of Credit Suisse, Thomas Gottstein. Still ahead, Cars.com is set to acquire fintech platform Credit IQ for at least $30 million. We'll discuss the deal on the back of their earnings release with the CEO, Alex Vetter. Next, this is Bloomberg.
supply chain team's done a great job on semiconductors. We've been able to secure semiconductors for our entire business globally and been able to keep all of our installations globally, which we do almost 10,000 every day, somewhere in the world, all on track.
This is Bloomberg Markets. I'm Matt Miller. Cars.com today released earnings in line with analyst estimates as the supply chain woes really smash into the car industry, but make used car purchases much higher in price. Let's bring in the CEO, Alex Vetter, and talk to him about what is just a really insane time for buying and selling cars, actually new and used. I shouldn't make it specific to used because dealers are able to charge 10, 15% above markup on a regular basis. What is it like operating in this? This is a climate that no one has ever seen before.
Matt, it's truly incredible. Despite the challenges and the headlines written about the auto market, it's a really healthy market, particularly for platforms like ours, which allow consumers to look nationwide, right? It used to go dealership to dealership. Now, through technology, consumers can see the market-wide view, on their phone and see exactly who's got what inventory in stock.
What is it, to me, coming from Germany, where I spend most of my time, it seems like there's so much opportunity here because in Germany, there's one platform, Mobil.de, that pretty much everyone uses. Here you've got such fragmentation, and it's like there's a huge prize up there for the winner. How do you get that?
Well, look, there are 40,000 dealers in the United States. We've got just under 20,000 of them as customers. So we think we've got a long way to go to win the rest of the dealers on our network. Make no mistake, though, every dealership as a result of COVID is trying to accelerate their adoption of digital platforms, services, and solutions and mimic a lot of what Carvana's done. But our strategy is different. We're trying to arm the rebel fleet. We want every dealership to be able to compete using tech.
Well, and people, right? You want consumers, when they think about selling a car or when they want to shop for a car, like Zillow, to go directly to Cars.com and think about nothing else. How do you do that? Is it a big marketing budget? Is the way you operate? Is it the app? What is it?
I say, like, when your name is synonymous with car shopping, Matt, it's pretty easy. The number of people that organically download our app or type in our name into our browser is significantly higher than any of our peer group. And so we actually can spend less in marketing and more in product development and supporting our dealer customers.
All right, so what do you expect in terms of the car market right now? The supply chain woes are something that we've been talking about with I've talked to the CEO of Volkswagen, the CEO of BMW, the CEO of Daimler about all of these things. When are we going to see that calm down a little bit, start to fix itself?
Well, look, I mean, production in Q3 was a low point. We're already seeing a rebound to production in Q4. There is a little bit of a global game happening here. The domestic automakers are bringing cars back at a faster level. So GMC, Chevy, Ram, Ford's doing a great job getting trucks and SUVs back on dealer lots. Inventory levels are way down. About 30% down on Cars.com as a market-wide view, but on every dealer lot, it's a similar story. The big drop is in new car volume, but used car sales are keeping the industry afloat. Dealers are reporting record profits because prices are up. New car prices are up almost 20%. And used car prices are up almost 40%. And so dealerships are having a record profit year, and they're investing more in technology to help accelerate their growth heading into 2022.
What about the demand side of the equation? I mean, that clearly got big during COVID. A lot of the kids who thought they didn't ever need a car wanted one to get out of the city into the country, and now they've become, I'm sure, addicted to it. So at what point do those comps get normal again?
Well, look, we're seeing the first time that the average age for registering a driver's license has gotten younger. It's been drifting away from 16, getting into the 17-year-olds. Now we're seeing the registration for licenses coming down sooner. So consumers are wed to their cars. It's because of COVID, people view the car as the safest, most reliable way to get around. And you're seeing this. EV sales now are bringing a whole new segment of the population into the market. We're seeing EV searches up almost 50% on our platform, particularly in markets like Seattle, Denver, San Francisco, cities that weren't necessarily booming car markets before the rise of EVs.
You can already get, I think in New York, with federal and state, I think $9,000 or even $9,500 back to buy, when you buy a new EV. Are those kind of incentives really helping the industry? Are they really pushing people towards an EV purchase?
Well, look, right now today, across all makes, all markets, all models, EV search share on cars.com is less than 5% of the total. That said, as this administration rolls out more incentives and talks about more stimulus for EV adoption, we are seeing consumer demand rise. EV searches, like I said, are up 50%. It's relatively small, but it's fast growing, particularly in key markets who are the biggest advocates for EV sales.
And of course, in America, everybody's waiting for these pickup trucks. You've got the Rivian, I think, making their first deliveries. Cybertruck is being pushed back a little bit. F-150 Lightning, everyone's waiting for that. What do you think? Who's going to be the king of the electric pickups?
Well, look, it's something our editorial team covers every day. We're covering each of these cars. We're driving them. We're reporting on them. We're posting ratings and reviews and our expert opinions. And so as consumers are overwhelmed with EV choices heading into next year, our experts here are curating the market on their behalf. And we hope to, have new reports coming out each and every week that talks about, you've got Porsche coming out, Hyundai's got their new EV car, the Ford Mustang Mach-E, Volkswagen ID. So every OEM has got an EV coming to the market. And so our editors are busy driving these and writing about them on our platform.
Let's not forget the Bollinger, by the way. I'm really excited about the Bollinger. Alex Vetter, thank you very much for joining us. Alex is the CEO of Cars.com. Coming up, shares of Moderna falling about 20%, ceding its place as this year's top gainer in the S&P 500. We'll discuss why in our Stock of the Hour with Kriti Gupta next. This is Bloomberg.
хорошо подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, ну, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
Даже это не пробовали, вот в чем дело-то. У нас же экспериментальный во многом этот проект. Поэтому мы сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть. То есть, несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее. Но это опыт, это первый раз. То есть второй будет проще.
every Friday with 30 minutes dedicated to fixed income. I'm Jonathan Ferro. This is Bloomberg Real Yield.
I'm Mark Crumpton with Bloomberg's First Word News. The United States has issued a federal rule mandating COVID vaccinations or at least weekly testing for workers at companies with 100 or more employees. It's the latest step in President Biden's push to use employer mandates to drive up vaccination totals nationally. The new requirement takes effect Friday. Workers must be fully vaccinated by January 4th or submit to testing. About 80% of U.S. adults have received at least one vaccine dose. If you are unruly and disruptive on a U.S. flight, you may face not only fines, but federal criminal charges as well. The Federal Aviation Administration is referring dozens of investigations into disruptive passengers to the Justice Department. Total reports of unruly passengers have surged to unprecedented levels in 2021. The FAA says almost 75% of the cases involve passengers objecting to the federal requirement that they wear masks. A chemical that causes cancer has been found in antiperspirant and deodorant body sprays. An independent testing lab is asking the Food and Drug Administration to recall all of the products with elevated levels of the carcinogen benzene. Products from Procter & Gamble brands, Old Spice and Secret, contain the highest levels of the chemical. They're the latest in a string of aerosol products found to contain benzene, including sunscreens and antifungals. China is dismissing a Pentagon report that says China is expanding its nuclear weapons capabilities faster than previously thought. The Pentagon estimated Wednesday's report that China will have to at least 1,000 nuclear warheads by 2030, including 700 so-called deliverable ones by 2027 that could be mounted immediately on various missiles. China says the report has a, quote, disregard of the facts. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
I'm Amanda Lang. Welcome to Bloomberg Markets.
And I'm Matt Miller. Welcome both our Bloomberg and our BNN Bloomberg audiences each day at this hour. Here, the top stories are following for you from around the world. As OPEC Plus rejects President Biden's request for a bigger oil supply increase, we'll speak to Ovintiv CEO Brendan McCracken on how the company plans to maintain production next year. Plus, remaking the Las Vegas Strip, MGM put the Mirage up for sale. We'll speak to the Vici Properties CEO, the owner of Caesars Palace in that city, and Moderna is tumbling. The fall comes after it cut its COVID vaccine forecast. The stock having its worst day since 2018. We'll dig into the details with Kriti Gupta. Amanda?
And Matt, Moderna, at least one reason why the healthcare subgroup of the S&P 500 is the worst performing today. We are seeing a move back into the high growth names that brought this market to its heights. So tech, communications, consumer discretionary, all powering higher today. Keeping our eye on financials, weakness there too as well, perhaps as the pace of interest rate increases are perhaps maybe delayed and certainly opaque. Those net interest margins very much in focus for the financials investors. Take a look, though, at NVIDIA at the bottom of your screen. We're watching the chips as a group because a number of them are powering higher today. NVIDIA jumping out at us with a 12% increase on still optimism around how it will benefit from the so-called metaverse. It will power, of course, a lot of the platforms that will generate sort of the activity in the 3D augmented reality world. But we're also looking at Qualcomm getting a similar double-digit advance on its outlook. So chips remain a big focus point here, of course, the source of bottlenecks, price increase. And for what it's worth, Matt, we talk a lot about pricing. We're waiting for jobs data tomorrow. But today, a read on the economy that is a telling one. Productivity in the U.S. falling by more than it has since 1981 in third quarter. That is reflecting a few things, not least wage growth. Non-farm productivity decreased at a 5% annualized rate. rate. That did miss analyst estimates, although they expected a decline, Matt, and at least part of that is because productivity, of course, is output per worker, and if your workers cost more, their productivity technically falls.
Also, I don't think the metaverse is up and running yet. I mean, I know that I called a number of people. I wanted to get some economists on the air, and I did a round of calls the other day. Throughout Europe, every economist I know is working from home still, and it's very difficult, or much more difficult, to get a hold of people from home. I feel like as the IT infrastructure increases, as the metaverse gets easier to use and easier to work from, that productivity may come back up. Let's, I won't wait for your reply. Let's get to the stock of the hour right now. Moderna will not meet the lofty expectations for vaccine sales that had been anticipated, and shares are being punished, maybe because you don't need to get a vaccine if you work and live in the metaverse. Bloomberg's Kriti Gupta is looking at the results for us. Kriti?
Well, Matt, it doesn't have anything to do with the metaverse, don't worry. But, you know, this has everything to do with the guidance. $20 billion was what Moderna said that they were going to be selling in the third quarter. They came out with $15 to $18 billion. So a sales disappointment when it comes to those vaccine sales. And we know that Moderna it needs to kind of get that big boost going to be able to sustain some of that momentum that it's had this year in particular. But I really want to talk about cash positions, because some of those supply chain issues that we've been talking about with a lot of other companies, the shipping delays, just the fact that it's more and more expensive, plus it's going to take longer. Exactly. Well, Moderna kind of insulated from it. In fact, when they talked about it on the earnings call, they said, well, it's actually not that much of an issue. It's kind of minimal impact, because when you have these orders, it's kind of already baked in. These logistics are already figured out. So they don't really have to worry about it. And for that reason, they have these massive cash positions at the moment.
What about other vaccine makers? I did see Pfizer was weak today. Is Moderna's shortfall being felt by them?
It absolutely is. It's trickling through all the vaccine makers, Pfizer, Novavax, even BioNTech. Those shares are down pretty substantially. And remember, this comes on the back of some pretty great earnings from Pfizer. But the common theme here is that ultimately some of these huge vaccine gains are going to kind of trickle down into 2022. Pfizer, for example, came out and said that they were coming out with $36 billion in 2021, $29 billion in 2022. So there is that slow, I don't want to use the word tapering out of context of the Fed, but tapering for some of this vaccine demand, especially for Moderna, where in the second quarter, 2/3 of their vaccine supply went to the U.S. In the third quarter, 96% of their vaccine supply went abroad.
All right, really interesting stuff, Kriti. Thanks very much for joining us. Kriti Gupta there with our stock of the hour. Still ahead, will domestic oil producers step up their production after OPEC Plus rejects President Biden's call to increase output? We'll talk with Brendan McCracken, President and CEO of the energy company Ovintiv. This is Bloomberg.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now.
Wrap it
into
up.
weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Today's $2 billion buyback is an important step, I think, and it shows confidence that we have in the underlying performance of the business and outlook, and shows a commitment to try and normalise our capital base.
This is Bloomberg Markets. I'm Matt Miller with Amanda Lang. Today, OPEC and its allies said they will stick to their slow pace of oil production increases relative to what President Biden wants, and they're rejecting his demand to increase production. The group approved a 400,000 barrel a day production hike for December. That's a pace that major consumers say is too slow to sustain the economic recovery. So I will repeat again, Amanda, that it's really interesting to me that we see the leaders of the biggest countries in the world gathered at COP26 trying to fight climate change and, at the same time asking OPEC Plus to please pull more oil out of the earth so we can burn it. It doesn't really jive, and as someone who regularly buys gas for $7 or $8 a gallon in Berlin, the prices here don't seem that high to me, but I know everything is relative.
Well, but you're also highlighting the tension that is the reality for OPEC, right? The world leaders are saying we're going to try to do without your product as soon as we possibly can. And meanwhile, as we transition there, we'd like you to make less on it. OPEC will say, forget about it. If you're telling us we're a sunset industry, we plan to sell as much of it as high price as we can while we can. And they're forgiven for thinking so. It creates a problem that's both political and also obviously climate, because we are all still consuming a lot of this oil, and now we're doing it more expensively.
All right. Yeah, it's certainly an interesting issue. I want to talk to Brendan McCracken about it. He is the president and CEO of Ovintiv, which owns a multi-basin portfolio of oil and natural gas producing assets, huge producer in this industry. So, Brendan, thanks so much for joining us. I wonder if, first of all, I know you guys are based in Denver now, but I'm going to guess you're Canadian. Is that right?
I am Canadian, but based in Denver.
Still, you're working in...
Great to be here today.
The U.S. of A. If President Biden asked you to increase oil production, what would you say?
Well, look, Matt, we've been really clear about how we're creating value with our business. And we don't see a call on growth today. We've always got to take into account a multitude of factors on making a risk decision there. We're also clear we're delivering on debt reduction. And so our business strategy today is maximizing free cash flow and generating returns on the capital that we are invested in. We're set up to generate some $15 to $20 billion of free cash flow over the next decade at modest prices compared to where we see today. And that's been how we've been running the strategy of the business. And most recently, we announced a new capital allocation framework. And that framework we're already in action in. Today we're paying a 6% cash yield on our equity today with a combined base dividend and share buybacks. And we think that's the right value proposition for the business. And that cash yield's actually set to go up as we reduce debt, but we need to do that debt reduction before we consider other capital allocation options.
Brendan, few in the energy sector expected oil prices to be where they are. So the assumptions for many have been to operate and right-size your own costs to a lower price. As you look down the road, and I'd ask you to look quite far down the road, what is that price? At what price of oil can you still be profitable so that any upside is gravy to you and your investors?
Yeah, really our company's been at the forefront of a industry transformation where the industry is switched from being a value creation industry through growth to an industry that creates value through cash returns and return of cash to shareholders. And we've been at the front end of that. This is our fourth consecutive year of generating free cash flow, even in 2020, which was a really tough year. And so to your question, we've driven our break-even WTI cost down into the low 30s. And that's been a real result of the innovation of our team to drive capital efficiency into our business. And so we've got a really resilient business today. And we think about running the business at mid-cycle levels, which for us is 50 to 55 level on TI.
I can't let up on questions about the administration here, Brendan, because I find it so interesting. And because, the president really wants to do what he can to make life a little easier for your average American at the pump. Has the Biden administration reached out to you? Is somebody at the administration speaking with somebody at your company about production?
Yeah, I think what I'd say there, Matt, is if we, and we have dialogue with the governments that we work in, and all you mentioned at the outset, we're in many places. So in the jurisdictions that we're in, so myself and my team do dialogue with policymakers. And I think what we need to see is better collaboration between policymakers and industry to find solutions that enable responsible producers to invest and drive down emissions. And for us, that's encouraging innovative solutions that are enabling technology. And, I'd be happy to talk about a number of the milestones that we've recently delivered on around emissions reductions. Some fantastic performance, dropped methane emissions by 33% this year, year over year. But I think what we want to see is those regulations and policies that avoid punitive policy and regulation and instead encourage innovation that drives those emission reductions, but yet still encourages investment and meets the world's energy needs, which is the point you're pushing on.
Yeah, and of course it's an important point. It's a political one, Brendan. I guess I would ask you whether you think the climate, the atmosphere in the U.S. right now is pro-production for you. We do see the Biden administration asking OPEC to produce more oil, and yet there are, you could argue, regulatory environments, certainly infrastructure pushback on pipelines that would say it's actually harder to produce and ship oil in the U.S. today.
Yeah, this is a very complex space, and every company in it is navigating those hurdles that you talked about. I think one of the first steps that policymakers should consider in the U.S. is moving away from the methane tax that's proposed in the reconciliation package and instead using the regulatory process through the EPA, which we saw some early drafts on just yesterday, as the policy tool to drive emissions down. And I think responsible producers like our company, would welcome that dialogue and discussion to encourage that innovation and meet that, tough compromise between the energy needs that the economy has and the emission reductions that we need to achieve.
Brendan, great to get some time with you. Really appreciate you joining us. Brendan McCracken there, President and CEO of Ovintiv, coming to us out of Denver. I like to say that over and over again because I think everyone is jealous when they hear someone has a job in Denver. Let me get to back to New York here, Amanda. It looks like we're getting some breaking news. New York City Mayor-elect Eric Adams says he'll take his paycheck in Bitcoin. I don't know if anybody expected this, and I recently heard from, Aaron Rodgers said he's going to take his paycheck in Bitcoin. He's not working right now because apparently he didn't get a vaccine. But this is absolutely fascinating. Mayors historically do fun things. You've had some great fun mayors there in Toronto, for sure. But this is pretty unbelievable. Now, it's only the first 3 paychecks, but he really wants to make New York City a crypto hub, and this could be one step in that direction.
Yeah, it could be. It also will highlight some of the complications of trying to pay somebody in a constant way in a fluctuating asset price. So it may actually highlight the soft underbelly that we know as Bitcoin. We're going to have more next. Stay with us.
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
Today, as the pandemic fades, will job restoration accelerate? Will a tight labor market push wages up?
I don't think we've ever had a hotter jobs market.
Tune in for the October Jobs Report Friday on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets. I'm Amanda Lang alongside Matt Miller. Well, Las Vegas has been fetching record prices for real estate. That has led MGM to put the Mirage Casino up for sale. Known, of course, for its lava-spewing volcano and tiger attraction, MGM Growth Properties that owns the Mirage is being acquired by Vici Properties for about $17.2 billion. We have with us Vici Properties CEO Edward Pitoniak. Edward, thanks for being with us. Let's just start here with what you're getting for $17.2 billion, and obviously we've seen strong prices here. What's your vision for this?
Yeah, so Amanda, good to see you again, as well as Matt. For $17.2 billion, we are getting 7 marquee assets on the Las Vegas Strip, as well as 8 magnificent assets in the regional gaming markets of the U.S. This is a tremendous portfolio, both in scale and in quality. It's occupied by an operator, MGM, that we believe is one of the greatest leisure, hospitality, entertainment operators on earth. This will give us an overall portfolio across the U.S., from Lake Tahoe in the west to Atlantic City in the east, actually to Springfield, Massachusetts in the east, if you want to get as far east as we will go, that gives us unrivaled access to what is one of the most dynamic consumer discretionary sectors in America right now, which is gaming.
It's pretty incredible. I mean, you're going to, will you own a total of 10 properties now on the Strip? What are your economic expectations? Because Las Vegas is very dependent on the U.S. economy. We're obviously seeing a big rebound right now. How do you expect that, Ed, to carry on?
Yeah, so Matt, the way we think about the Las Vegas Strip is that it is, we believe, the most economically productive street in America, frankly, if not the world. It is proving that, obviously, in the recovery from COVID, but it proved it before COVID, and we believe that there are a number of trends in place that will continue to make Las Vegas one of the most vital and vibrant tourism, leisure, and business destinations in the world. As an example, we announced that we're buying the Venetian, the biggest asset on the Las Vegas Strip, back on March 3rd. We'll get 7,000 hotel rooms, the biggest single hotel in America. We'll get the biggest privately owned conference, convention, and trade show space in America. And the most important customer at that asset is not a gambler. It is, in fact, one of America's largest corporations, because that corporation uses the Venetian to carry on critical elements of its business model in terms of its engagement with its customers. That is where a tremendous amount of its engagement with its customers takes place, at the Venetian. So that we think the prospects for Vegas are just tremendous, and you are absolutely right, Matt. We will have a very, very strong position along that very productive street.
You have made, obviously, a series of sizable acquisitions, Edward. So just in terms of the ability to finance all of that while continuing the payouts that investors will be looking for, just reassure on kind of the balance sheet, on your capital structure, that you feel confident going forward if there is a massive downturn that you're still okay.
Yeah, so Amanda, since we started 4 years ago, we have done $30 billion of transactions. To carry out that $30 billion of transactions, we will have used about $20 billion of equity and $10 billion of debt. We have raised all of the equity we need to close on both the Venetian and the MGP transactions. We will be raising debt further down the road. But in terms of the quality of our balance sheet, we have steadily migrated upward in terms of quality, to the point where when we announced the MGP transaction back in early August, both S&P and Fitch said that if Vici can get leverage to a number of 6 times EBITDA or below by late 2022, we will move Vici to investment grade. And with the equity we raised in early September, that equity raised in September, which helps pay for MGP, ensures that we will be below the level of leverage we need to get to investment grade.
Couple of important metrics there, Edward. Great to have you with us for that. Appreciate it. That's Edward Pitoniak, Vici Properties CEO. And that's it for us today. For Matt Miller, I'm Amanda Lang. Stay with us.
Hong Kong lost its top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
From New York City.
We're here in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'm Mark Crumpton with Bloomberg's First Word News. House Speaker Nancy Pelosi is sounding optimistic that the chamber will approve both President Biden's social spending agenda and his infrastructure bill. Speaker Pelosi shied away from giving exact timing for the votes. Although much of the bill has been written, there was last-minute wrangling over a plan to raise the limit on deductions for state and local taxes and on immigration. Shares of Moderna are falling. The company lowered its estimate for 2021 coronavirus vaccine sales. Plus, it missed estimates for quarterly revenue and profit. Moderna is vying with Pfizer and BioNTech in a race to lock in orders for booster shots for next year. The logjam of U.S. imports stacked on ships off the coast of Los Angeles isn't just getting longer, it's getting wider. The number of bigger ships that can carry more than 10,000 containers has jumped from 23% at the end of August to 30% this week. The average wait for ships bound for Los Angeles exceeded 14 days this week, roughly the amount of time it takes the fastest carriers to cross the Pacific. OPEC and its allies are disregarding President Biden's demand to produce oil faster. After a meeting today, the group said it will stick to its slow pace of oil production increases. The cartel agreed to a 400,000 barrel a day production hike for December. That's a pace that major consumers say is too slow to sustain the post-COVID economic recovery. The U.S. is asking for as much as double that amount. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
The most crucial moments in the trading day. This is Bloomberg Markets The Close with Caroline Hyde, Romaine Bostick, and Taylor Briggs.
It is 2 p.m. in New York, 6 p.m. in London, and we're live from Bloomberg's World Headquarters. This is Bloomberg Markets The Close. I'm Caroline Hyde.
I'm Romaine Bostick.
I'm Taylor Riggs. And the record run, it continues, guys. Tech retail sale shares are in charge. All eyes now on Friday's jobs report as traders, of course, pair rate hike bets following Wednesday's Fed meeting. Romaine has the Nasdaq's winning streak. For Taylor, it's a dramatic day in the debt world. We've got you covered. Talking of drama, the UK may have another unreliable boyfriend on its hands. The Bank of England defying expectations by keeping rates on hold, shocking traders, sending the pound into a tailspin. This is a global central bank story, and we're going to bring you the analysis of it. Meanwhile, OPEC Plus is taking it slow, rejecting President Biden's plea to speed up oil production increases. Could the White House now tap emergency reserves? Crude markets in the red. All that and so much more this hour, Romaine.
Yeah, but let's do check in the market. You mentioned the NASDAQ streak here, the composite up 6 straight days, the NASDAQ 100 up for a 9th straight day here. And you talk about the broad-based rally that we had yesterday. It is narrower today, largely led by a lot of the tech names as well as some of those discretionary names. You're talking about a day where you got NVIDIA at a record high, Qualcomm up 13%, Microsoft, AMD also at record highs, as is Etsy also at a record high as well. The MSCI Emerging Markets Index, this is an interesting move. This is its first up up move now after an 8-day stretch of losses. A lot of concerns here about how a lot of these EM stocks would sort of weather a rising rate environment. But after we got the Fed meeting and then, of course, the BOE meeting, the general sentiment seems to be that at least there's still a little bit of dovishness left here in the major central banks. That's given a bid here to some of these EM stocks. And then at the bottom, we're going to talk about this a little bit later, but crude oil has been all over the map here. We're going to have Rebecca Babbitt on a little bit later to kind of explain what's going on.
Let's go back to that central bank conversation, because it's exactly what we're seeing within the bond markets here in the U.S. as we take our cues as well from the BOE, as Romaine mentioned. 5-year yield, 9 basis points down in yield on the day. This is the 2-day period to show you where we'd gotten yesterday after the Federal Reserve. So there was a sense this morning, Caroline, that we really needed to digest and maybe pull back on some of the forward rate hikes that we had already pulled forward and sort of maybe sit and think that we are a little bit of that dovish tone. What is so interesting, take a look at this terminal. You're still pricing in, the markets, I should say, for by 2024. But pink line, that's by December of next year. And that's the line that's come down. We're now pricing in just about 1, no longer 2 rate hikes by the end of next year. It's the pink line, not the green one, that's moving.
Thank you. Thank you, Taylor. That's a great chart, by the way.
Thank you.
That's why you've always been my favorite.
Oh. Stab to my heart. Meanwhile, let's bring in Brett Ewing, Chief Market Strategist at First Franklin Financial Services. Brett, it is a fascinating sort of second-day reaction from the Federal Reserve, but really reaction from other central banks. This is a global story. And meanwhile, you have parts of Europe and Asia hiking. I think of Czech Republic, I think of Poland, I think of what's happened over in Korea. But here we see the British central bank take everyone by surprise, not hiking. And therefore, are we expecting more dovish policy coming out of central banks pushing against the market?
Well, it seems it's been a little interesting. That was a surprise move out of the bank this morning, Bank of England not having the rate hike. I think that threw the bond market off a little bit. Also with the taper decision yesterday, I think that it was very much in line with what the market was expecting. But I also think there was a little dovish undertone into when they would actually and how they would do the rates if and when they would do them for next year. So,
Brett, if you're thinking then that indeed inflation is allowed to move a little bit hotter while we focus on the labor economy, is it all in on equities as we've seen yesterday for the record highs?
You know, Taylor, I think that what we're really paying attention to right here at the market is a breakout that we're really getting out of the Russell 2000. It's recently broke out of a 9-month channel this week, and we think we needed that breakout in order to continue this melt up in the equity markets. I do think that equities are really the best value right here. I still don't believe the market is overvalued based on forward earnings. I think we've missed the earnings guidance all year long. So I do think we have another 3 to 4% melt up. I look for the S&P to hit 4,800 before year end. But I do believe we're going to have a much greater amount of volatility in 2022.
Yeah.
In fact, looking for about a 10% correction in the first half of the year.
Wow. I want to just take one step back, Brett, to your comment about the Russell 2000. We saw, of course, hit that record high yesterday after being relatively dormant for a few months here. And I am curious about kind of the idea of re-embracing the cyclical side of this trade. On a day like today, and even to a certain extent yesterday, we saw more people kind of embracing more of the growthier names here. Do you think people are still sort of tethered to that cyclical trade, that they still believe in it?
Oh, absolutely. We are very much involved in that. I do believe in the industrials, the financials, material-related companies. I think that this economy is really booming. Look at the ISM reports that came out this morning. Very strong. We're going to have a jobs number here coming up this Friday. We are looking for momentum back into the job market after the low of 2021 in September. So
none of the supply chain issues, none of the productivity issue that we saw today cause for concern there?
Well, I think that those numbers can be noisy in the short run, but what we're looking out as we look into the summer of 2022, We know that there are tens of thousands of individuals and companies working on these supply chain issues that are out there 24 hours a day. And I do believe that innovation and ingenuity will rule the day. And one of the thoughts that we're having right now is that actually we overshoot on the supply chain fix, and it becomes probably the most efficient global supply chain the world has ever seen by summer of 2022. And in fact, you could have areas and pockets of deflationary pressures that emerge by the third quarter of 2022.
Right, before we get to that third quarter of 2022, you mentioned, I believe, correct me if I'm wrong, you're looking at a 10% correction in the first quarter-ish of 2022. Why? What's behind that?
Well, look, the market bottomed in March 23rd of 2020. We're up approximately on the S&P 500 over 100% right here without even a 7% correction. We've had a couple 6 and a 5% correction in September. I just think if the market melts up going into the end of the year, 3 to 5%, I think we need at least a 10% correction just to wash this market out for us to take it to higher levels in 2022.
All right. Well, of course, a lot of folks keeping an eye on that. Brett, really great to get your insights. Brett Ewing, Chief Market Strategist over at First Franklin Financial Services. All right. Now, a lot more coming up on the show. We're going to continue to talk stocks, but we're also going to talk, of course, what's going on in the commodity space. OPEC Plus rejecting President Biden's plea for a bigger oil supply increase. Rebecca Babin, Senior Energy Trader at CIBC Private Wealth Management, going to be joining the big show. Plus, the CEO of Dine Brands also going to be jumping in here. Of course, the parent company, Caroline of Applebee's and IHOP, your favorites. We're going to talk to him. John Payton going to be joining the show as well. And also the CEO of Kyndryl. This is the big spinoff of IBM, the Infrastructure Services Unit. Martin Schroeder is going to be here to talk about his company's plans for a sales turnaround. All that and more coming up next right here on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Bank of England totally defied market expectations today by keeping interest rates on hold, putting its credibility, in fact, on the line as it chose to prioritise the risks to the economic growth story instead of tackling inflation that they've been talking up. Governor Andrew Bailey actually defending the decision earlier in a conversation with our own Bloomberg Francine Lacroix. Take a listen.
Two messages. One, we expect there will need to be a rise in interest rates. Two, however, because we condition our forecast on the market curve, as I did point out, our forecast suggests that by the end of the forecast period, 3 years away, inflation was coming a bit under target, probably on a declining trend, and we had an output gap opening up, and obviously that wouldn't be what we were wanting to see.
Governor, if we can go back to markets, and it was this "we will have to act" that at the time seemed pretty hawkish.
Yes.
So again, why did you not temper it, or did you actually at the time, weren't not enough worried about growth?
No, it's a statement, and by the way, it's a statement I hold to today, which is that, of course, in those conditions, particularly if we're seeing, inflation expectations beginning to become de-anchored, we will have to act. There's no question about that. I don't resolve from that one bit.
But so did the markets misread you? Is there a communication problem?
No, I don't think they misread at all. What I would say, however, is that nobody in the Bank of England, me included, said, therefore, there will be a rise in interest rates in November. That was nothing. We've never said that. Now, actually, interestingly, and I think Bloomberg, you published your economist survey, and it was pretty evenly balanced on what we were going to do today.
Nice to see that he's keeping abreast of Bloomberg News. Meanwhile, Bank of England Governor Andrew Bailey was, of course, speaking with our own friend. It seemed like earlier. I've been eating some granola.
Let's continue this conversation. She's so choked up here. We got Michael McKee in the house, our Bloomberg Chief Economics and Policy Correspondent, to kind of help us walk us through some of the big moves that we saw this week out of the various central banks, Mike. Of course, you had BOE, you had the RBA, and of course, obviously the Fed. And overall, the market seems to be reacting to the idea here that this is maybe a little bit more dovish than what they had expected.
Well, given the idea that a picture is worth 1,000 words, I brought along a chart that showed what happened this week with the major central banks in Australia, Great Britain, and the United States. And it really tells a story about
Romaine's going to love this.
What happened. Yeah, if they can pull up that chart, that would be great. Because this was a lot of activity, and the volatility was amazing. Those three banks were expected to do a lot, and they didn't.
This is gold, Mike.
There are reasons. Let's take a first look at the Bank of England. The reason, which was just laid out by Governor Bailey, is that they raised their forecast for inflation next year, but lowered it for 2023. And you can see that on the screen there. And then you can also see what the GDP forecast is. And you can see all the way to the right there, the output gap developing. And that's why they decided to hold. And it wasn't even close. It was a 7-2 decision. There were a lot of people that thought it would be as evenly divided as the economists.
I know that we want to get back to the Fed, but we first have to talk about what's going on with the Australian 2-year yield, because there were stories out that a lot of hedge funds have seen the volatility and are reacting to the volatility, and their losses are reflecting the volatility. What the heck is going on over there?
Well, it's an interesting setup because the Reserve Bank of Australia did a monetary policy experiment that only the Bank of Japan has done, and that is they did yield curve control, something the Fed talked about doing but decided not to. And the reason they decided not to is what happened to the RBA. You can see the red line there is yield curve control. That's where they promised to cap yields. And if yields went higher, they would just buy as much of whatever to bring it back down again. But then last Friday, the markets decided inflation was a much bigger threat, and they pushed that's the 3-year note there, way above the target.
There are your vigilantes.
And it would have, those are the vigilantes. It would have cost them a fortune to keep fighting that trend. And so they decided yield curve control had to end. That didn't mean rates rose. I mean, the market rates rose, but the RBA says they're going to wait a couple of years, they think, until they will move the official rate.
Tell you where is hiking? Czech central bank today.
Czech central bank.
Poland,
they did, and 125 basis points, the biggest rise in 24 years. So they got a reaction on the markets, the corona strengthening.
All right, Michael McKee, I know, who showed up with 2 wonderful charts. Mike, you are now my favorite. Bloomberg's Michael McKee there. Coming up, we got a lot more to talk about on the show. CEO of Dine Brands Global, the parent company of Applebee's and IHOP. They reported earnings. He's going to be here to walk us through that. John Payton coming up next, right here on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, what the challenges with getting people back into the workforce.
Gasoline prices are high because it's mixed with ethanol that went tenfold. Gasoline prices are high because there is low stocks in the U.S.
Take a look at shares of Dine Brands. Of course, you know it. Parent company of what? Applebee's, IHOP. You could do pancakes for breakfast, lunch, and dinner if you want. Applebee's comp sales are up about 28%, coming in ahead of estimates. IHOP comp sales 40%, also ahead of estimates of about 38%. And really, still you're looking at some of those full-year expenses near the higher end of the range of $168 to $178 million. All you guys, as we've taken a look at some of the higher input costs, as we think about labor, we think about wages, we think about food inflation, and all of that going forward. Let's do it all with Dine Brands Global President and CEO John Payton joining us here in set. So great to have you back here in New York. Talk to us about the comp sales, the strength that you're seeing, people really returning to the restaurants.
So thanks for being here, and it is fun to be on set and seeing you all in 3 dimensions. It's a great change. So Dine Brands had a great quarter, and we're super proud of it. For the second quarter in a row, both Applebee's and IHOP beat their competitive sets, which means they're gaining share, and they are accelerating their growth at a time when some of the other restaurant companies are not. For the first time since the pandemic began, same restaurant sales, weekly sales, it reached pre-pandemic levels. First time we've seen that. And financially, we had a 48% increase in EBITDA quarter over quarter. Mm-hmm. So a super strong quarter for the brands as well as for us, financially.
Talk about the sales mix between dine-in customers and the takeout, pickup, delivery type customers. Obviously, you remained open during the pandemic. Most of your locations remained open, and you were able to transition primarily to a takeout service. How much of that has stuck around?
It's very sticky business, and that's important. So I'll give you some perspective. Mm-hmm. So pre-pandemic, for both Applebee's and IHOP, about 10 to 12% of our business was off-prem, either delivery or takeout. Today, it's 25 to 27%. Mm-hmm. And what's more important than the percentage, because that will decline slowly as guests return to in-restaurant dining, is the absolute dollar amount. So for Applebee's, that's about $14,000 a week in off-premise business, $8,000 for IHOP, and that number has been trading in a pretty consistent range for a year and a half. So what we did during the pandemic is we invested in the consumer apps necessary to allow them to order, online and pick up. We improved our processes back of house for delivery, et cetera. And so we view this as new incremental business, new customers that have found us, and we're now in the consideration set for takeout and delivery today in a way that we weren't before the pandemic started.
Of course, you're a 100% franchised organization, so your menu, your marketing, you're the technology side, but talk about what also you support, which is the people and the brands and the growth. What are you hearing from your franchisees at the moment in terms of how hard it is to fully staff, how hard it is to continue to raise the payment of their labor when you're trying to still make a good margin?
So labor, honestly, is the number one issue that keeps me up at night. Yeah. It's not even necessarily the cost of labor, which is increasing $1, $2 an hour, depending on the region of the country. Across both of our brands nationally, we're at about 85% of where we should be in terms of staffing. And that's been the same as last quarter. It's pretty steady. And there have been theories about if the stimulus ended, people would come back to work. We're not seeing that. So we're really doing two things at the same time. We're trying to be very realistic about the current state, helping our franchisees with ideas and programming for recruiting, for even more importantly than recruiting, retention, because hourly workers for 50 cents will move next door. So you really have to invest in the culture, in learning, in training, in promotion opportunities in order to keep them once you have them. But the other question that we're asking ourselves is this the new normal? And is this labor environment where it's so hard to find labor and we're 15 percentage points shy of fully staffed, is this the next several years? And so we're really looking at the technology like automation and robotics in back of house, in the kitchen, in AI to ensure accuracy of takeout and delivery, to make sure that we're planning for what might be the new normal.
One thing you can automate is the food inflation. Those are costs we can't really get around. What food inflation prices are you seeing, and can you pass that on to the consumer?
We are seeing commodity cost increases. So we're estimating for the year it'll be about 6%, but it is escalating. It was 10% for the quarter. So about 10% back half of the year, 5 or less in the first half of the year. One thing that's important to note is because we're 98% franchised, each of our franchisees makes its own decision about when and how to raise menu prices. What I can tell you historically is our franchisees raise prices about 1 to 3% a year. This year, they're much closer to 3%. The math, though, is important to keep in mind, which is food cost is 25% of our total cost in a restaurant. So you have to raise prices 2.5% to cover 10% of inflation. It's not a one-to-one match in order to maintain profitability for our franchisees.
And they're doing that math on their own, or do you help them at the corporate level doing that?
We have lots of tools and suggestions and training for them, but the decision is made exclusively by our franchisee.
All right, we're going to have to leave it there. John, really appreciate you stopping by. John Payton there, of course, he is the president and CEO of Dine Brands Global, of course, the owner of Applebee's and IHOP. You've been to both of those, Taylor.
Of course
we haven't gotten Caroline into either one of those just
yet. She
needs
a good pancake for
lunch. We have to get a good old
I
American.
I'm going to order in.
So, Caroline, here's a suggestion. It's pumpkin spice pancakes at IHOP. That's our special this fall through Thanksgiving.
You had me at pumpkin spice.
All right, well, that's going to lure her back there. All right, almost here at the bottom of the hour. We're going to reset here, get a quick check here at what's happening in the commodity space. Settlement of NYMEX crude coming up in just a moment, right here on Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down, and if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked about other things. Now that's moving to become mandatory.
week on Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference, this week on Bloomberg Television and Radio.
Do you see Deutsche Bank ready to pay more and pay out more in terms of bonuses for staff to have that strong talent that I'm sure you want?
Well, look, it's a war for talent. It has been, in other cycles before. It is now. We're finding that we're competitive in that war for talent.
I'm Mark Crumpton with Bloomberg's First Word News. The United States has issued a federal rule mandating COVID vaccinations or at least weekly testing for workers at companies with 100 or more employees. It's the latest step in President Biden's push to use employer mandates to drive up vaccination totals nationally. The new requirement takes effect Friday. Workers must be fully vaccinated by January 4th or submit to testing. About 80% of U.S. adults have received at least one dose. A federal judge expressed skepticism today when attorneys for former President Trump asked her to prevent the handover of documents sought by a House committee investigating the January 6th insurrection. Judge Tanya Chutkan disagreed with claims by Mr. Trump's lawyers that Congress did not have a legislative purpose for getting his call logs, talking points, and other notes from January 6th as his supporters stormed the Capitol in hopes of overturning his loss to Joe Biden. China's President Xi Jinping says his country is open to negotiations on subsidies to its industrial firms, as well as state-owned companies. Those are key points of trade tensions with the U.S. Speaking at the China International Import Expo in Shanghai today, Xi said China will take a, quote, active and open attitude to talks on issues including the digital economy, trade and environment, and industrial subsidies. New York City Mayor-elect Eric Adams says he will take his first 3 paychecks in Bitcoin when he takes over City Hall in January. Adams told Bloomberg this week he wanted to turn New York into a crypto-friendly city. The mayor-elect said he wagered a, quote, friendly competition with the mayor of Miami, who was the first to set up a so-called Citycoin cryptocurrency. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
This is Bloomberg Markets to close. Look at this. It's also 2:30 here in New York. A little after that, getting ready to look at what's happening in the commodity space. If I can remember.
Did you almost forget?
I almost forgot what we were doing here. But there we go. We do this every day at 2:30, so you think I would remember.
It's a bit rusty.
Looking settlement of NYMEX crude futures. This is actually a pretty big move here. We're going to have a guest up in just a second here to talk a little bit more about this. But you're looking at settlement below $79 a barrel here on WTI. A lot of this has to do, of course, with the announcement by OPEC Plus. Combine that, of course, with rising inventories out in Oklahoma, and you put all that together here, and you're getting a little bit of dip here in prices. Meanwhile, gold going in the opposite direction here. A lot of people interpreting the latest moves by the central banks, the major central banks, to be a little bit more dovish than what folks had priced in over the previous few weeks here. And then cotton down pretty significantly here. Cotton futures, we should say, a second time we've seen this week, down about 2% right now. A lot of this has to do with the fact that you're now starting to see a drop-off in orders. And some of that has to do, of course, with the fact that prices has gotten so high. Most of those drop-offs in orders are coming out of China, of course, one of the biggest consumers there, and that's having now a downward effect on prices. Meanwhile, sugar going in the opposite direction here on expectations here for some weather that will be favorable to prices. Joining us right now, though, we want to turn back to what's going on in the oil space and bring in Rebecca Babin, senior energy trader at CIBC Private Wealth Management. And Rebecca, the big story today is really about the announcement that OPEC Plus is basically sticking to these output goals here. But kind of baked in that is this whole idea here that President Biden, the United States, has specifically asked OPEC Plus nations to do a little bit more to kind of get prices down. And They pretty much did not get that out of this meeting.
Yeah, so that's exactly right. And in listening to the press conference that was held after the OPEC release was put out, it was pretty clear they were speaking directly to the U.S. in their commentary, which said, we didn't create this problem. This is a power crisis that started in Europe. And the reason why you're having this issue is because you transitioned away from fossil fuels and into other energy sources that are not as reliable. And if you look at the price of crude right now relative to nat gas in Europe, it's actually cheap. The equivalent price, if you converted nat gas in Europe back to crude, is $125, right? So they're saying, well, and we haven't had a massive move higher like you've seen in nat gas. So they're kind of really they really pushed back against all of the calls for them to increase output. And they further doubled down on that by saying, not only is this not our problem that we didn't create, you created it, but looking forward, we're still going to be increasing production. And guess what? U.S. Production isn't really increasing. So you haven't even held up your end of the bargain. I found the press conference pretty assertive and spirited, to put it mildly. And I think today the reaction you're seeing in the commodity is actually the market realizing that that was a direct shot across the bow, and the Biden administration probably can't go ahead and do nothing now. And they will need to figure out if they're going to release an SPR or do something else to try to react to the OPEC decision.
Yeah, certainly. Many now anticipating the Strategic Petroleum Reserve might well be tapped. Talking of assertive, talking of that back and forth, we've actually got a little bit of sound coming from the Saudi energy minister as he defended that decision that they made. Just take a listen quickly, Rebecca.
We have a record to show comparing us as OPEC Plus, not as what some of you unfortunately call us as a cartel, but as a responsive regulator to a market that needs to be regulated.
A market that needs to be regulated, now a market that potentially needs the US to dip into its strategic petroleum reserves. Are you expecting that in the next week, in the next couple of weeks, Rebecca?
I would expect it within the next couple of weeks. And the reason I say this is because the rhetoric has been so public, and this issue has become very political around U.S. gasoline prices during the time when we have, approval ratings falling and different things happening in the country domestically. I think the onus is going to be on the administration to take action here. I would be surprised if they don't. And I think the market's also telling you that today in terms of the trading action, that the probabilities are skewing heavily towards that.
Rebecca, how do you think the U.S. responds? Because I imagine it's tempting to start producing, to start drilling again at almost $80 a barrel. The efficiency levels have gotten so good that looks profitable. But as you mentioned, we're coming off of COP26, where there's been this big focus on the shift to renewables. How does the U.S. respond?
Well, that's a great question, Taylor, and this is the key. The reason why U.S. producers aren't increasing production right now is they don't have visibility into the future of what the environment looks like, the regulatory environment, the permitting environment. So they're saying, great, crude's higher now, but by the time I start putting some, holes in the ground, things could change, and this could not be as profitable for me, or I could be regulated out of profitability. Secondly, Wall Street has really drilled into every energy producer's head. I need to see cash flow. I don't want to see increased exploration and production. So it's a twofold issue, and I don't think the U.S. in the near term is going to be able to fill this gap with production. Over the long term, if we see a softening or a backing off from the Biden administration on some of his policies, we may then incrementally start to see some advancement in companies starting to be able to look at the visibility and make decisions about increasing production.
Just real quickly, only about a minute left here, Rebecca. I want to get your thoughts here on natural gas here in the U.S. Prices still kind of hovering around those 7-8-year highs here. Any sense here that we could see that market, I guess, revert back to the mean in some particular fashion?
Yeah, and there is that chance, but I'll tell you what it's based on, and it's based on weather. And, your guess is as good as mine on that. So it's kind of a weather game at this point over the next several months. I can just tell you when we've had huge moves like this and we do get a reversion to the mean, it's pretty aggressive and not pretty. And that would be my guess, is that we do see that. I think a lot of the bad news or bad weather is priced into the nat gas market at this point, but you never know. You get a rough winter and it could spike.
Rebecca Babin, it's always great to have you. CIBC Wealth, private wealth management senior energy trader. Stay well. Come back soon. Meanwhile, still ahead, shares at Etsy. They're staying well, climbing after earnings, while supply chain challenges across traditional retail may actually be a tailwind for Etsy. It's our stock of the hour. This is Bloomberg.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. Do
you think you're the last Sinophile in the cabinet?
No, I expect there are lots of... look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
BSO Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
All right, the Ebony Power 100 has honored the remarkable achievements of African Americans across industries and highlights outstanding leaders across a variety of fields and disciplines. Bloomberg actually partnered with Ebony on presenting this year's list. It was an excuse for Caroline and I to put on our best clothes. I was in a nice little tux, and she was in a nice little number there, Taylor. I'm sorry you missed it, but next year
there was
you'll
a great
be there.
red carpet, though, of you guys.
And we were on the red carpet. And
Wonderful.
You know who we talked to? We talked to a lot of great people here, including who we're going to hear from next year. They're the honorees in the Next Gen category. category. They're the founders, the co-founders of BlackGen Capital. Take a listen.
To be able to research and get a really good edge on them because a lot of Wall Street analysts don't cover these specific stocks.
So they're public companies?
Yeah, public companies that we focus on. Our students, after a 10-week education series, they culminate all of the knowledge that they learned into a stock pitch, which they present in front of our entire general body, as well as corporate sponsors. We invite analysts from various firms on Wall Street come and sit in on these stock pitches and judge them. So it's overall just a great experience to get students hands-on experience and really apply the knowledge that they're learning.
Are there certain sectors that you focus on besides just mid-cap?
Certainly. So our students are working in 4 different sectors. That includes healthcare, energy, technology, and consumer. And we place them into these groups based off of their interests, academic background. So, for example, computer science students, of course, tech, pre-med students, healthcare, and they really get to get a deep dive in those industries and flex their experiences and interests.
You're seniors.
Yeah.
Do you take BlackGen Capital on? Does it become a longer-term fund, or do you go to Wall Street? What are your ambitions?
So we live by the mission of paying it forward. So eventually, we hope to pass down BlackGen Capital, the entire leadership, and keep it going for the next 100 years. At Cornell, at Georgetown, eventually at NYU, and many other schools across the country. We continue this model of paying it forward, we can expand this impact exponentially.
And the other kids at school here, I mean, how do they view you two specifically? I mean, because this is pretty impressive. I mean, I don't know what you were like when you were a junior in college, but we weren't as ambitious as you two.
Yeah, being in a leadership role in an organization like this, students look up to you, of course. And so that gives us an opportunity to inspire and really pay it forward, like Shek had mentioned. And many of them text us, at midnight, hey, I'm preparing for this interview, can you help me out? Can you walk me through a mock interview? Things like that. And so, that's what we're all about, just helping people that helped us.
All right, these are 2 college students who basically started their own investment program here called BlackGen P. Our parent company is one of the sponsors, not only of the Ebony Power 100, but also of BlackGen Capital, we should say. There's going to be a full program with all the interviews we have, including Questlove, Big Frida, and a whole lot more. Jimmy Jam and Terry Lewis. That's going to air at 8 p.m. Eastern Time tonight. Don't miss it.
Don't miss it. Get your popcorn. Good old LA days. Meanwhile, let's get back to the here and the now and the moves in the market. Our stock of the hour is Etsy. Shares headed for their best gain in 18 months. Earnings coming in better than expected. Bloomberg's Kruti Gupta joins us for more. And this is a company that, well, in the depths of COVID, showed that it was a go-to, and now in the depths of supply chain crisis is also a go-to.
It is getting a win-win no matter what. It seems hitting a record high after those earnings. And I mean, this is fascinating because the biggest move for the company since April of 2020. And this was actually down after hours yesterday because of that lackluster forecast, similar to Amazon earnings last week. But the psychology this time around is that exactly what you said, Caroline, that in the holiday season, people are going to be dealing with those bottleneck supplies by going to alternative marketplaces, which is Etsy. And in the long term, even, revenue growth is still forecasted to be extremely strong. And some of that actually showing up in their peers today as well. So you have the likes of Chewy, for example, higher on sympathy. Wayfair, not so much, simply because of their own earnings story. But there is a lot going on here to the point where when we're talking about peers, Etsy actually has an even higher enterprise value than its peer Amazon.
How is Chewy at an Etsy?
It's an online marketplace. It's an online marketplace for your pets. You can go holiday shopping there.
Quickly, just the light forward guidance. Should that be a concern?
It usually shouldn't be a concern. They tend to do this. They tend to keep their expectations low, let the market kind of anticipate low earnings, and then they come out and they beat. It's a strategy that worked for me before a test in grade school, and apparently works on the corporate level as well.
All right, Etsy, it's our stock of the hour. Are we buying everything on Etsy? Is that the agreement this year for Christmas?
Yes. Oh, yeah. What are we getting?
It's just a few more days until Christmas.
Do you want me to get you cat toys for when you babysit Mocha Bear on Chewy?
And you bring the costume.
Yeah, we want to. He will only look after Mocha Bear if he's in his. What was he? A pirate?
Cowboy.
He was a cowboy.
Come on.
Kruti Gupta, thank you, bringing us all the sense in Etsy while we digress. Meanwhile, coming up, becoming independent.
You look so disappointed in his screen.
After officially separating from IBM, Kyndryl becomes its own separate company, and it makes its trading debut. We're going to be speaking with the chairman, the CEO, Martin Schroeder. That's next. This is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
111 million people use Twitter every day all around the world. 20% of those are in the United States. The top of funnel is really healthy. So we get a lot of at-bats, and we just need to keep doing a better and better job of converting people to help them make Twitter part of their daily ritual.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
IBM's spin-off of its managed infrastructure services business, that's Kyndryl, it officially became an independent company and started trading on the New York Stock Exchange today, launching the world's largest IT infrastructure provider. Joining us now, Kyndryl Chairman and CEO Martin Schroeter. It is great to have some time with you. Busy time, big step forward for you. Why, for your part of the business, is it good to now be listed, to be independent, to be forging your own path?
Yeah, look, it's a really good question, and you said it well when you introduced us, which was we are the leading infrastructure services company, and if we're going to get back to growth, if we're really going to help our customers the way we best in building new capabilities, and then importantly, we need to participate in the market ecosystem that exists that our customers are asking us to be a part of. So at the heart of what the spin does, at the heart of what independence does, it allows us to invest and it gives us the freedom of action that we need to go participate in the ecosystem that exists in the world today.
What about the issue of scale? There's been a lot of talk here about the competition in this area and the relative, I guess, importance of scale here. Does this work against you at all?
No, not at all. So look, I think as the largest, we have the scale we need, and scale really plays a role from two perspectives. From a labor perspective, we have 88,477 of the best digital engineers on the planet. And that labor pool, with an average of about 10 years of industry experience, gives us the scale we need. The other element of scale is data and IP, and we have sufficient scale to start anyway there as well. We have over 3,000 patents in the areas that our customers are interested in cloud and data and security. So the labor scale is certainly sufficient. We are going to be building out and investing in very heavily our services delivery platform, which turns all of our data into useful insights and useful reduced operational risk for our customers. We start in a great spot with the scale we have, but again, we'll keep building our pools of data, we'll keep building our insights, but we certainly start with the scale we need to be successful in this industry.
How are investors responding to this sort of standalone versus and doing it from what you couldn't do under Big Blue when you talk about $19 billion in annual revenue, investment grade credit ratings where you're beginning, and customer relationships that give you that annuity-like revenue stream that investors, of course, love so dearly? Are investors hopeful that this go-to-loan approach is indeed going to be a faster and a meaner company?
Yeah, look, I think investors are certainly looking for us to prove the story that we think is quite compelling. And the story starts with the journey and a security journey. And those are the similar journeys. Those are the similar investable theses that I think our investors have. So what investors expect is that we can move into those journeys of our customers by expanding the ecosystem in which we play, as I mentioned. So we're really tied into the way investors think about the marketplace. And now it's up to us to really shift this business into this broader ecosystem and to really shift our skill base to where the market's growing.
Where is the market growing at the moment, Martin? You help with just-in-time manufacturing, real-time shipping, inventory tracking. This is all of the digital economy that you serve. Well, those are all areas that are completely clogged in the economic system right now. You're also depending on 88,000 members of talent, and we're just speaking to a previous CEO who's saying really labour at the moment is what keeps him up at night. How are you feeling about the economy right now for you?
Just yesterday, that was completed, the infrastructure services operation there. We are almost towards the top of the hour here, final hour of trading.
Проходим опасный участок, ответственный. Рустам поднимает тебя на жумаре. Шерпа страхует.
Очень много думал о том, что я сделал, и понял, что сделал какую-то нереальную вещь. Не знаю. Я до конца внутри себя даже не могу поверить, что я через это прошел. Состояние, наверное, организм истощен, потому что очень много физической работы. Своим вот этим поступком я хотел сказать, что только через действие в этой жизни достичь можно абсолютно всего.
Your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I'm Mark Crumpton with Bloomberg First Word News. House Speaker Nancy Pelosi is sounding optimistic that the chamber will approve both President Biden.
But in order to do so, we have to have votes for both bills, and that's where we are.
The speaker shied away from giving exact timing.
Probably on the back of 1 million workers, coming out of furlough and the end of a payment program, probably decided to stay on the cautious side.
Within that cautious side, therefore, do we expect equity investors to stay cautious? Do they go into big tech because of it's a safe play, or are they going into big tech because they suddenly don't see perhaps the interest rate hikes they had originally?
Well, you see, the way I see it is the next 12 to 18 months are going to be very volatile. Why? The environment's going to remain positive for equities overall because you want to have a risk on lack of clarity and uncertainty. To me, the key factors to look at are really around real rates. So we know that we're about to have some level of normalization, but remember, inflation has been quite strong. So real rates remain very, very accommodative, which is very good for stocks in general. Second, inflation. We know the structural versus cyclical element, and there it's more to me about the calibration of that green policy that we have around the world and the effect of potentially on wage of inflation. The third one is really economic growth. And again, I refer to this base effect, but also to the fact that China is slowing down very rapidly, and China is a very important part of global growth. And of course, we have reached peak cyclical, if you want, mid-cyclical peak dynamics. And finally, we also have, perhaps on the demand side, some level of frugality after the events of the pandemic, and of course, a fiscal cliff. So all of this means that people are going to want to be cautious. You want to diversify your portfolio. You want to have some value because rates will be normalizing over time. But you want a strong diversification around thematics, around style, and perhaps some systematic equities as a bedrock, or quantitative equities as a bedrock.
What about diversification geographically? Do you go global?
So I really think that the market over the next 12 to 18 months is going to be a stock picker paradise, in the sense that not all markets will move, in big tandem waves. So you want to go global in a way, but really pick the sectors or the themes that you like. So I still like very much, as I have for many years, climate mitigation, cybersecurity, smart cities, China. I think the market has corrected a lot. And of course, tech and generally artificial intelligence, or the enabling of all sectors with tech and AI. I think those are very, very strong themes.
The correction in China has been pretty severe, Virginie, but a lot of the issues that led to that correction still seem to persist there. How comfortable are you with, I guess?
Said you have some extraordinary, innovative companies in China, in biotech, in technology, in industrials that I think are really, really, attractively priced right now to put in a global portfolio.
Very global, and with us from London. So we thank you so much for saying that a little bit latey for us, Virginie. Always great to have you on the show. Virginie Mazenova, Global CIO for Equity at Allianz Global Investors. Coming up, we're keeping a close eye on the markets as we push towards the closing bell with Nancy Tengler. She's Chief Investment Officer for Laffer Tengler Investments. Plus another big day for earnings after the bell. We'll bring you results from Uber, Square, Airbnb, Peloton, you name it, we're on it. And they cross soon. And a programming note, tonight 8 p.m.
What's happening?
Oh, it's going to be special. Remains in a tux. I've got a little bit too much makeup on. No. We've got a special on the Ebony Power 100. We had to do it. We're on the red carpet, guys. But most importantly, it's honouring the achievements. Someone had to do it. We had to do it because there's some remarkable achievements you have to shine a light on from the African Americans across a variety of fields: business, sports, media, you name it, investing. This is Bloomberg.
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the city of
This is the countdown to the close. 47 minutes left to go here in the trading day. Another record day for the S&P 500, 4671. A lot of folks looking past 4,700 now to 4,800, saying that could be the next milestone, though they do say once we get there, it could be in store for a correction. Dollar strength here, gold getting a bid as well, of course, all on the back of the big announcements that we got out of the Fed and, of course, out of the BOE. There's your 2-year yield right now going in the opposite direction that a lot of traders had bet on just a couple of weeks ago. Flip up the board. Let's take a look at some individual movers here. Probably the most interesting story of the day, interesting stock of the day, is Tesla, firmly back above 1,200 here. Another record high here. You're talking about a stock right now that has been on fire here over the last few days, and it's really become a barometer of risk sentiment. Now, despite the big gains that we've seen in Tesla all year, up 60, 70% right now, it's actually not the best performer out there, not the best performing car stock out there. It actually belongs to Ford. Ford shares have actually more than doubled here on the year-to-date basis. Here they're up about 3.6% here to the downside. Moderna really getting hit hard. This has been, for most of them, to give up that crown here. It had been up about 300 and lose its crown as the best performing stock of the year. Hanes brand under pressure here because of concerns about the cotton supply chain. It's time now for Options Insight. Every day at this time, we bring in Abigail Doolittle to talk us through what's going on in the options market. And Abigail, we got to talk a little bit here about the VIX here. For 2 straight days now, we've seen the VIX trading below 15 here. And it seems to reflect some general sentiment here that everything is all clear. Is that what I'm supposed to read into it?
Well, I like that race that you set up between Tesla and Ford, because that really suggests that the risk-taking continues to remain on. And if that's the case, maybe the VIX range right at the bottom of it right now, to your point, perhaps it breaks to the downside and we go into like the 12 or the 11 handles, similar to a couple years ago. But to talk more about this, whether volatility remains suppressed or if we are going to see that VIX go back above 20 as some investors start to hedge, Matt Rao, an executive director at Nomura. Great to have you with us as always, Matt.
Thank you.
And I think that you really want to bring the idea of inflation versus deflation into the volatility conversation. So talk to us about why that conversation, that inflation-deflation debate is so important to you when you're taking a look at equity vol.
Well, I think, we hear a lot of investors and market participants trying to figure out ways to protect against inflation. And what it's really done is created sort of a lopsided payoff profile in the market where you've got so many people trying to bet on and pay for protection against inflation. It's really left the deflation aspect underappreciated, I think, to some degree. We've done quite a lot of work on that. We've seen, like I mentioned last time, Cathie Wood and others, Jack Dorsey, doing battle on that over Twitter about what will happen first and what's the bigger risk. And really that's the debate for monetary policy as well. And we've seen that out of the BOE, and we're starting to see commentary from Bill Dudley and others around this. So people are trying to figure out which direction the risk is in.
So if we bring the VIX or volatility, different forms of it, into the conversation, it's really interesting that you're talking about deflation and inflation, because of course until the last 6 months when everybody's been talking about transitory inflation, over the last decade or so, the big worry has been deflation, not even stagflation, but deflation, even going, quite frankly, back to the bust of the housing crisis. So that's been the issue. What is the VIX and other volatility telling you? Is it deflation or inflation that we need to worry about right now? And not just this month, but going right into 2022.
Yeah, well, so there are a couple of different ways to read this. When interest rates are dropping on days like today across the board, and the curve is really, really falling, rates are coming down pretty quickly on people's read through to the Fed as well as the BOE. And we're not surprisingly seeing, as you mentioned, Tesla and a lot of other growth companies. I mean, if you can even call Tesla